So welcome everybody to the Retirement Plan B live masterclass series. Our team has never tried to plug together so many different technology to get this studio set up in a way. We're going to be doing this for the next week or so, where I wanted to go live. Bitcoins are all new all-time highs. We've got inflation, the highest surges that we've ever seen for 30 years. And so it's been almost exactly 1 year since we launched the Retirement Plan B 4-part free video series last year, and an awful lot has happened. So what I wanted to do is do a recap of everything that we went through in the last free 4-part video series and get an update on everything that's happened since. So let's do a bit of housekeeping first. Azad, if you're there, if everyone can hear okay as we're getting interaction, everything's good?
Yeah, so let's just see the comments. Everyone, can you all hear us? If you can, just give a thumbs up or say yes.
Great. Okay.
Okay, so all looking good so far.
Excellent. Okay. All right, so a little bit of housekeeping. So what we wanted to do is put together a complete masterclass series, completely free for everybody that has been following on YouTube and is interested in getting a second shot at what we did last year. So let's go through a little bit of housekeeping. This session we're going to be focusing in, and even though this is the title, we're going to cover so much more. We're going to be going live until as many questions as we can take are answered. And we're going to be going through, should I buy and sell Bitcoin now, which is the #1 question. Those that haven't bought Bitcoin are going to be thinking, the price is so high, is it too late? Have I missed the boat? Those that have bought Bitcoin are really going to be thinking about, is now the time to sell? And so if you've got those questions, we'll start going through those. But I aim to get that answered for you, exactly what I've been doing and how I'll be doing that. So that's the first video, and that's the masterclass that we'll be covering today. In a couple of days' time, at this time, in about 2 days on Friday, we'll be going through Masterclass 2. And Masterclass 2 is the #1 question that we got when we surveyed everybody. How do I deal with all the cryptocurrency taxes and everything that's happening on the tax side? So I recently, if you're not following me on Twitter, at Simon Dixon Twit, I went live and shared some of the updates that are happening on the tax side. And in Masterclass 2, we're going to be going deeper into that subject. In Masterclass 3, which will be next week, we're going to start on Monday. We're going to be going through how do I create a cryptocurrency retirement plan, structuring the legals, how to set up an asset protection structure, and some of the things that we've been, or I've personally been using over the last year or so in order to take my retirement plan and build it around the strategies that we talked about in the last 4-part free video series. In Masterclass 4, we'll be going through exactly an update on everything that's happened since then. So that's where we're going through the build and protect your wealth, and that will be 1 day after next week. And I think by the time we're all done, there's probably going to be about 10+ hours of live streams here. So let's do a bit recap on what the 4 3-part video series was all about. This time last year, as we said, I wanted to show people. Now, many people came to me and said, Simon, it's all right. You know, you were involved in Bitcoin from the early days. You got lucky. What would you do if you were starting again today? So I wanted to answer that very question this time last year. We were deep in the midst of the pandemic. People were very concerned. People didn't know what was coming next. And so I wanted to share and just reveal everything that I could. And I also said, I'll put my money where my mouth is. You know, you may be thinking that, you know, I don't buy Bitcoin anymore, or because I was around since the very first Bitcoin conference. But I put $1 million on my personal savings and shared with everybody exactly how I'm investing, and invested it live with a group of approximately 500 people that registered for our Retirement Plan B online wealth management program. I also did the same thing, but showed how I would do it if I had zero savings and just a regular income. If you don't have a regular income and you don't have savings, then unfortunately, there's nothing we can do. Your first job is to get yourself a regular income or get yourself some savings. But if you do, I also shared, because some people will be thinking, yeah, well, I haven't got $1 million. Well, it scales down to $1,000, $10,000, $100,000, $1 million, $10 million, $100 million. You can scale it in any direction. The number, it does not matter. It's the percentages that matter. And so rather than waiting, we started revealing. And so that's exactly what we did in the 4 3-part video series. The videos that we released, just as a recap, we did the Great Depression of the 2020s. And what we're going to be doing in this live masterclass is we're going to be returning to those videos, and then we cut them up, and then I'm going to tell you what's changed since. So we get real-time feedback and reviews on everything that has happened since then. If you're new to me, if you are, most of people may be very familiar with me. I'm going to just play a bit of a video just in case people aren't familiar with me. As I said, my name is Simon Dixon. I spoke at the very first Bitcoin conference. I published the very first book in the world to include Bitcoin, which is Bank to the Future, Protect Your Future Before Governments Go Bust. And over a decade since it was published, everything has become more relevant today than it was back then. I talked about things like modern monetary theory. We talked about investing in technology companies. We talked about Bitcoin. We talked about how everyone would be moving to freelance contractors, and some of the trends that I'm going to be sharing as we review what's happened over the last year. So I was forecasting the Great Depression of the 2020s, and I'm going to share with you why the Great Depression of the 2020s was one of the most unique times that we've ever seen in human history. In the second video that we covered was talking about exactly the lessons and mistakes that I've learned from some of the wealthiest investors and highest profile Bitcoin figures. And we'll be reviewing those lessons in Masterclass 2 and sharing what actually the impact was by following some of those lessons. The third video that we'll be reviewing in Masterclass 3 was on 5 Bitcoin investing strategies that make up my retirement plan B. And I was revealing exactly the thinking behind where I simplify it to those 5 Bitcoin investing strategies. And we'll actually, in this lesson, be doing a review of how those performed as well. And then finally, we did the final video, which is where we recapped everything. Now, one thing I fundamentally believe in is that repetition is the mother of all learning. And so I constantly have to re-review things. I have to go back to things. And whenever I repeat things, it's because it may be something you can intellectually understand. But if you did not implement Retirement Plan B last year, then you intellectually understood it and you haven't learned it until you've actually done it. And so if you think that reviewing these videos again, that suddenly we've got something completely brand new has come along, the strategies, the fundamentals are the same. And if you did not implement it over the last year, then that means that you have not learned it by my definition of learning. So in video 4, we did the build and protect yourself. What we did after that is we invited 500 people to join me on the Retirement Plan B online wealth management program. We had 500 spots, and full disclosure, full transparency, you're going to get a lot out of this wealth mastery going through the online wealth, the live masterclass, getting my words jumbled up, the live masterclass. But at the end of it, after video 4, we will be inviting the next 500 people to join the online wealth management program. We were inundated with emails and comments from people that didn't make it last time, but we are saving 500 slots for those that want to join us. And this time we'll be taking everything we learned from taking the first 500 people and doing it, and putting and implementing those there. So, you will get a lot from the free live masterclass. The goal of last year's video series was that for those that are not in a position to do the Retirement Plan B online wealth management program, can take the free training and do with it as they choose. And maybe they followed it, and if they did follow it, they're probably in a position to be able to invest in the online wealth management program this year, but we're limiting it to 500 spots just like we did last year. So, as I said, the free live masterclass, content rich, and for those of you that want to join us, then you'll get the opportunity to do that after we've got through the 4th masterclass. Right, so some other things and some housekeeping that we'll be doing. If you want the best experience right now, if you're watching this somewhere else, we decided that we would stream it on Twitter and on YouTube and Facebook. However, if you head over to retirementplanb.com, then you're going to get the best experience. The reason for that is because we're going to be answering as many of your questions as we can. And those questions can only be answered on the retirementplanb.com website underneath the video. So below this, you should see exactly as is showing on the screen right now. Above this, you'll see the video, and it should be me on the video there. There we go. And below that, you can see the Slido embed, and that's where you can get your questions answered. So we'll only be taking questions from those that are in www.retirementplanb.com. We want to give you a carrot and a stick, and the stick is that any questions, you have to head over to the platform because we've optimized the experience, and we're going to be sharing and taking questions for those that are on there and on the live stream as well. Next thing, we will be recording this. However, the recording will not have some of the bonus sessions that we're going to be doing just for those that join the live viewer session. So here's the questions. So it's only at Retirement Plan B that you can get your questions answered. Next section. Now, if you are watching this on YouTube and you have not registered yet, then we're going to be sending all of the notifications for those of you that have opted in on retirementplanb.com. So the way that it works is you put your name, your email there, and don't put your fake email, because we're going to be giving you notifications of everything as we get through the masterclass. That's where you're able to get your questions answered. And if you want to watch a recording, we appreciate it. We understand some of you are working, you're all in different time zones, but we also want to reward those that join us on the live session. And so we'll have content from some of the experts and mentors that were part of the online wealth management program. So today we're going to be doing our very special live bonus session with a recording from the Retirement Plan B Wealth Management Program from Andreas Antonopoulos. And in each live session, for those that join us on the live, we'll be jumping in, giving you a sneak peek session where you get to see that. So firstly, make sure you register there if you haven't done that already so that you get the best experience. And we'll be sharing all of the notifications via email to those the people that have opted in there. And as we said, we're going to be doing some content just for those joining the live sessions with some of the experts that were part and made up the Retirement Plan B online wealth management program. So that's our little incentive for joining the live sessions. But we also appreciate some of you might not be in a position to join the live sessions, but you won't be getting those bonus sessions. So that's the sneak peek sessions that we're going to do. And at the very end of this, we're going to be doing pulling out some of the training from Andreas Antonopoulos so that we can make it relevant to the live masterclass for those that tune in right till the end. Now, we're not quite sure how long we're going to go on for. We've got a lot of content to cover. This could go on for anywhere between 2 and 3 hours. We'll try and make it shorter. We understand that some of you may not be in a position to make it for the whole thing. But if you are willing to play full out, I'm going to give you everything I've got and make sure that you are in a position whereby you have immersed yourself. So I'm a strong believer in immersion. Every time I want to master a new subject, I immerse myself in everything that I want to learn in a condensed period of time so that I can then implement it and start learning from experience. What I want to do with this live masterclass, the way that it was designed, is that you immerse yourself in it. So I suggest, I know that some of you will be watching this while doing emails, while having a million notifications. Switch your notifications off, stop going to the emails, immerse yourself, play full out, and I'm going to give you everything I've got. My energy comes from you in the comments section, asking great questions, engaging on retirementplanb.com. And the more engagement that we get, the more energy I'm going to have, and the better the questions, the more I'm going to be able to give you new teachings and direct this in the direction that is most suited to the viewers and audience. A bit more housekeeping. None of this can be construed as financial advice. I am, back in the day, did all my financial planning certificates and exams, but I am no longer registered as a qualified financial planner and a financial advisor. And therefore, you cannot see any of this as financial advice. This is for educational purposes, to immerse yourself so that you can be equipped with some of the tools to set your own financial advice and work with other financial advisors that have a greater understanding of your individual situation. So I will be sharing exactly what I do, and I will be sharing, and I've paid incredible amounts of money over the years to financial advisors, and I'll be giving you what I've already paid a lot of money for. However, if you are looking to tailor this to your individual situation, then you need an individual financial advisor to support you in that. I'll give you the crypto content, I'll give you the context, but if your personal levels of assets, liabilities, your personal financial situation, your age, when you want to retire, all those things have to be done with qualified financial advisors and the tools that we're going to be sharing. So you cannot construe this as financial advice. The next thing that this is not individual investment advice. I'm not going to be sharing you one of those pump and dump videos where I'll be sharing with you the secret tip of the coin that I'll be putting in. This isn't going to be me saying, put your money over to Shiba Inu and Dogecoin and all this type of stuff. There is a place for you to play around and gamble, but this really isn't the type of masterclass that this is going to be. So I won't be giving you individual investment advice, but what I will be doing is I'll be sharing with you exactly what I'm investing in, reviewing that, and sharing some of the returns that have been achieved as well in the last year in real time. Also, in the second masterclass, we'll be covering tax as a subject. So much has changed, and the importance of getting yourself set up with asset protection structures and understanding your tax situation has become more and more important. But I am not a qualified tax advisor. I pay a lot of money to tax advisors, and I can share with you some of the things that I have learned, but none of it can be treated as tax advice. And so you would need to get your own tax advisor that really understands the uniqueness of your situation. And finally, in Masterclass 3, we'll be covering a lot on the structuring side. And structuring is really a subject that needs to be done with a lawyer that understands how you want to set up your inheritance situation, how you want to set up your retirement plans. And really, that would be a lawyer. And I am certainly not a qualified lawyer. Having said that, I'll be sharing with you the structures that I've been using and we've been building over the last year for those that want to understand a bit more about some of the structuring options. So you can share them with your legal advisor and decide what is right for you and what is best for you. The other thing, we tried for the last week to figure out how to get rid of that blur right there, that light there, but we failed miserably. So I'm hoping it doesn't bother you too much, but it is what it is. Maybe I'd need to invest in a brand new big screen, but this one was expensive enough just to get set up and with some anti-glare, but we'll make the most of it because anyway. So that's the housekeeping. Now, what I wanted to do, just in case anybody doesn't know who I am, we're now going to get to reviewing the first video that we released last year. And the first section of that was me sharing a bit more about my background, not to really, because I like sharing all that stuff, is because I want to show you the range of experiences that we're bringing to the table here so that you can understand, because I personally believe it's really important to know who you're learning from and that they live, walk the talk, and talk the talk as well. So now what we're going to be doing is we're going to be reviewing video 1, and then I'm going to be going to what has changed since then. The first part of that, the first video that we're going to play right now, is the first half of video 1 from the 4-part video series, where I shared a little bit about myself, my background, and then we'll jump into some of the 5,000 years of monetary history, so that we can all get ourselves up to speed, we can level up. Now, as I said, if you have watched that already and you haven't implemented, then you have not learned. And it's time to learn again. It's time to review. It's time to get the repetition as the mother of all learning, and then doing. And my goal is to make sure that you have all the tools and everything you need to implement, not just learn academically. So I'm going to now head over to the screen share, and we'll play the first half of that, and I'll come back and we'll be going through the next section.
My name is Simon Dixon, and for the last 20 years I've dedicated my life to understanding how to invest when the day comes when central banks announce unlimited printing, zero to negative interest rates, and the Great Depression of 2020 arrives. That day has now come, and I'd like to share with you exactly what I'll be doing to protect myself. I'll share how to put together what I call a retirement plan B. In fact, I'm going to go one up and implement it live with $1 million of my personal savings, as well as show you how I would do it today, even if I were starting with zero savings and just had a regular income right now. To understand why I'm doing that, you need to understand the environment we find ourselves in today and why I published a video in 2011 called The Great Depression of the 2020s. In this video, I want to give you 5,000 years of monetary history as fast as I can in plain and simple English to save you the 20 years of research and experience that I've been obsessing over in order for you to build and protect your wealth in the Great Depression of 2020. Now, before I do that, I'd like to share with you why I built my own retirement plan B and why I think it's more important than ever today. For me, it started in the year 2000 when I began my formal education and completed a master's in economics. That kicked off my obsession around monetary history, but left me deep in debt. At the same time, the tech boom turned into a bust, and my father lost all his retirement savings to the stock market in a recession. If you're currently in deep debt or have ever been in a position where you lose all your money investing, I know firsthand how such financial anxiety can feel. It's one of the main reasons that I'm creating this free video series now. In order to understand investments better, I completed certificates in financial planning, securities, and investments. I started my career as a stockbroker. I later became a market maker on a London Stock Exchange's members trading floor, and finally worked as an investment banker taking companies public. Even though I had a good salary, I never spent less than I earned and never had money left over to invest. Throughout my life, I've seen a lot of people with great paying salaries in the same debt situation. In 2006, I left my investment banking career before the financial crisis hit, and I joined the global monetary reform community while presenting at many of the top UK universities on banking reform. I also had an opportunity to present in Parliament on the unsustainable nature of banking that would lead to a Great Depression. In 2011, I uploaded a video on my YouTube channel from a talk that I gave in 2009 called The Great Depression of 2020. At my lowest point in 2009, I was $100,000 in debt, losing over 25% a year in debt slavery interest payments. That very same year, Bitcoin was launched, and my wife and I later used our last bit of credit card debt to fly to Prague and speak at the first non-US Bitcoin conference in the world. After that, I published the first book in the world to include Bitcoin. The title of the book is called BnkToTheFuture, Protect Your Future Before Governments Go Bust. In 2010, my wife and I co-founded the online investment platform BnkToTheFuture.com, and we later used some of our personal Bitcoin gains to pay off all our debt and invest in the equity of many of the largest companies in Bitcoin, including Kraken, Bitfinex, Blockchain.com, BitPay, Circle, Ripple Labs, Bitstamp, Robinhood, and many others. In 2012, a documentary I was featured in on monetary reform went viral and now has 3.2 million views and still growing. From 2013, TV stations like CNBC, BBC, Reuters, RT, Press TV, and many others invited me to share my thoughts on global banking and financial issues and Bitcoin. In 2016, I predicted how central banks will use digital currencies to take control of the economy during a major market crash after the largest debt cycle in history. I also predicted how this could happen by 2020 in countless videos on my YouTube channel. In that decade, Bitcoin went up 9 million% and has now been the most consistent and highest performing asset class for 10 of those years. Tragically, I also saw many that were there from the very beginning of Bitcoin who lost all their wealth and, even worse, ended up deep in debt even though they were involved in the highest performing asset class in history. Today, I see so much financial struggle in so many people's lives, which has led me to create this 4-part video series on the retirement plan B I developed for investing during the Great Depression of 2020. So in this video series, I'll share with you what I would do if I were starting from scratch today using a retirement plan B step by step. But before I can do that, you need to understand the environment we find ourselves in today. In this video, I want to give you 5,000 years of monetary history as fast as I can to save you the 20 years of study I completed and help you make sense of what I think is coming next so you can prepare accordingly.
Okay, so I hope that for those of you that are new to me, I hope that explains a little bit about the journey that I've been upon and why we are doing this right now. So first thing I want to do now is get into a first bit of content piece. So I would like to be sharing with you how I decide when to sell, when to buy. As I said, most people are in a situation where either they start making incredible gains and they start thinking about selling, or they start, they reach a stage where they capitulate out, they, FOMO, fear of missing out, and they end up buying at the top, and people try and time the markets. But just by the question alone, I can tell that people are in what I call fiat thinking. So for those of you that have followed me on Twitter, I did a very popular video a couple of days back where I was working out at the gym below, and I was sharing my concept around my experiences of fiat thinking and Bitcoin thinking, and how that leads people to excessively trading and really trying to determine when to buy and when to sell. So the first thing I'd like everyone to do is appreciate that this whole concept of have I missed the boat? I have heard have I missed the boat every single day for over the last decade, from either someone tweeting me, someone emailing me, someone messaging me. I have heard literally the same question, is it too late? I've missed the boat, time and time again for the entire history of being involved in Bitcoin from the early days. I've seen my $30 Bitcoin crash to $3. I've seen my $1,250 Bitcoin crash to $250. I've seen my $20,000 Bitcoin crash to $3,000 rather. And I fully expect a $100,000 Bitcoin to crash to $30,000. Now, some of you might start thinking, oh, Simon Dixon is forecasting that Bitcoin's going to go to $100,000 and then crash back down to $30,000. So they'll start thinking, oh, maybe I should buy, I should be selling as soon as it hits $100,000, and then I should wait for a crash, and you get wrecked. I have avoided specifics of when to buy and sell for the following reasons. Because I used to be, when I was a market maker, I learned firsthand that we as market makers manipulate short-term prices in order to drive the emotional behaviors that happen in markets. And this is because we know that everybody thinks that it's about calling the top and calling the bottom. But the wealthiest people that I know, having built a community of over 150,000 investors at BnkToTheFuture.com, they really did not care about when to buy, when to sell, did not trade in and out, and they just implemented simple dollar cost averaging. And dollar cost averaging is the most simple concept to understand, but virtually impossible for people to implement. And it just means take a date, just like you set up your pension or set up your retirement plan, and just buy whatever the price is. And that is what I do. That is exactly how I set up my retirement plan. And There's some more advanced things you can do in terms of portfolio rebalancing and various other things. But hopefully this will build on each other as we go deeper and deeper into the content over the next sessions as well. But just have it be known, every single time that Bitcoin reach all-time highs, people still think that they have missed the boat. They end up buying when they're very, very nervous, and then the price capitulates. They get concerned that they missed the boat, and they end up selling at a loss, and then looking back in years into the future saying, I used to own $30 Bitcoin, or I used to own, so remember those tops. So I said, we had I remember in a period of a day, went 90% correction, $30 to $3. And sitting through that, it feels right now that you buying at $30 is a very, very foolish move. And so when it was $30, I remember the celebrations when people are, getting to $1, getting to $10. When it hit $30, people were thinking, this is crazy price for Bitcoin. When it hit $1,000, when it hit $10,000, every single time they always thought that they had missed the boat, it's too late, and they use that as a reason not to buy. And I completely understand the emotion of feeling that you're the last plonker. Sorry, that's a British term for those of you that are for those of you from Britain, you'll know that only fools and horses, Rodney. But you thinking you're the last plonker that bought Bitcoin at the high, and then it crashes, you feel like an idiot. But it's this, you got to learn how to zoom out. And so here's a real trick. When I think about Bitcoin, people are always asking me, how long is this bull cycle going to last? How long is it till this bear cycle turns around? How long is that going to be? And that's because they are in what I call fiat thinking. And fiat thinking is when you are thinking, what can I buy with my Bitcoin? And this means two things. One, you are not mentally adjusted to an appreciation of the 5,000 years of monetary history that we will be sharing with in a second, in the next video when we go into that segment. And it also means that you have not separated your living expenses from your investment accounts. And so if you are thinking of your investment account in terms of what it can purchase, then simply you have not implemented sound asset allocation. And so one of the things that we always do with our retirement plan beyond online wealth management program is make sure that they get their asset allocations fully defined based upon a financial plan that they put together so that they can just wipe out these I have missed the boat emotions and stop trying to call the tops and call the bottoms. It is a loser's game. 90% of traders lose money at the 10% of insiders. And these new people to Bitcoin come along and they all start trying to think, is it the right time to buy? Is it the right price to buy? And that causes them to follow the exact same cycle that everybody new to the markets goes through, especially in something as volatile as Bitcoin. Bitcoin has a life of its own. And so when I think about when I'm trying to call tops and bottoms, I don't start drawing lines and start looking at technical indicators. And by the way, I spent a lot of time learning technical analysis when I was a trader. And it really is a tool to try and put together the emotions of fear and greed into chart patterns and repeatable behavior based upon the emotions of fear and greed. However, I learned a long time ago that investors are the winners and investors are the great equalizer. Traders that try and call the top and bottom is something that only 10% can do, or insiders can do if they own enough Bitcoin in order to manipulate markets short term. Fundamentally, we're all equal. Fundamentals of Bitcoin mean that everybody can do a dollar cost averaging and everything can be the same as well. So what I like to do is I like to think of Bitcoin as simply, I'll try and go off the edge of the chart there. It's been a 12-year bull market and it has some corrections in between. And what your job to do is to filter out the noise. The way you filter out the noise is you go over to, for example, whatever charting software you use. You can go to coinmarketcap.com. You can hit on Bitcoin. You'll see thousands and thousands of cryptocurrencies. The first job, if you don't own any Bitcoin yet, is to ignore all of it. Now, every part of you is going to be thinking Bitcoin's too expensive. I need to find something cheaper. It's a completely irrational, completely illogical argument. Sorry about the white background. That's going to make me look a bit darker, but when I go to the next slide, we'll get the darker background and it will balance out. So the way to filter out the noise is to hit this log button right there. When you hit this log button, all it does is it changes the scale. And when it changes the scale, it just shows you this is what Bitcoin's been doing for the last 12 years. So when you're freaking out because Bitcoin price is crashing, and expect it. Bitcoin has repeated the patterns constantly, and people try and guess those patterns in order to determine when to buy, when to sell, and they end up with no Bitcoin at the end. They end up buying at all-time highs because they FOMO'd in. They didn't have the conviction. They didn't have the type of psychological tendencies that we are trying to install in all of the people at the retirement plan B side, that you can just sit back and you can relax, look at a logarithmic chart, and you'll just see what crashes, what bear markets. All a logarithmic chart does is it changes the scale so it filters out some of the noise. The data is the same. And so anytime you are tempted to sell is probably two reasons. Either you are trying to be a trader, trying to call the tops and bottoms, or, which is what everybody does, or you have not done asset allocation and separated out money spending from money that you're going to be investing. Plus, you're a fiat thinker. Now, what do I mean by a fiat thinker? A fiat thinker is somebody that is on the wrong side of the debt cycles that I'm going to be going through when we play the 5,000 years of monetary history. And remember, if you've watched that video, watch it again. We're going to be playing it shortly. Unless there's always a new distinction that you can take out. There's always, I tried to condense 5,000 years of monetary history into less than a 10-minute video or whatever it may be in the end. But you will be a fiat thinker. A fiat thinker is somebody that sees Bitcoin in terms of how much things it buys them. And so if you are excited during bull markets, and I get excited during bull markets, of course, we're all humans with similar emotions and psychology and emotions of fear and greed. And it's very exciting during a bull market because our industry gets so much more adoption, things grow, new funding comes in, companies' valuations increases if you're a BnkToTheFuture investor, and everything's all fun during the bull market. But I want you to have the most fun during the bear market. The bear market is something that I've become really excited about. When prices are crashing, if you are, excuse me, let me grab some water. Just while I'm doing that, if you are watching on YouTube, make sure you hit that like button. Really appreciate that. And do share it as well so that we can get more people here. But if you come over to retirementplanb.com, you'll be able to get your questions answered when you opt in, and we'll notify you as well. So just going to take a quick water. Okay, so fiat thinking is about thinking in terms of what it will buy you in dollars, in euros, in yen. Bear markets are times when you get to accumulate Bitcoin. So if you're a Bitcoin thinker, you've understood that the trend in Bitcoin is about rewarding the saver. In fiat world, it's about a world's largest regulated Ponzi scheme. And if you're not, sometimes I use financial jargon. Many of my audience will be very familiar with words like fiat. But fiat is just simply a way of describing government-created currencies: pounds, euros, yens, dollars, as we'll go into the monetary history. If you're a fiat thinker, then you're thinking in terms of what it will actually buy you, and you appreciate that the value of your fiat goes down over time. So those that are deepest in debt are playing the game of fiat thinking. For those that are buying assets using their fiat, then that's where you need to think in terms of the asset that you're using at the base. And so a Bitcoin-centered retirement plan is really about ignoring the dollar value, implementing some hedges in there to do sound risk management and asset allocation, but thinking in terms of Bitcoin accumulation. So whenever you're thinking about the wider crypto markets, it's about Bitcoin accumulation. When you're seeing bear markets, it's about Bitcoin accumulation. The best time to accumulate, if you're dollar cost averaging and you're just simply buying as your income comes in, is when the price is down. And so what we constantly see over the last decade is that people, they say, oh, if Bitcoin, is $68,000, we're at all-time highs, I can't possibly buy here. So they don't buy, and then they say, if it crashes by 70%, I'm going to remortgage my house and I'm going to do everything and I'll scoop up as much Bitcoin as I can. And guess what they do when the Bitcoin crashes 70%? Oh, thank God I missed that. I missed a falling knife, and I'm not touching any of that stuff, and they leave the market. So you're going to have to be longer term, and the way you get there is through logarithmic charts. Understanding, phasing out the noise, thinking long term, because investing is the great equalizer. Trading is where you get wrecked. It's a game for the insiders, and you create tax liabilities for yourself. You create complications in your accounting. You create complications in your financial planning. The inheritance is a nightmare, all sorts of stuff. So simplification is the game of being able to play the long-term game and riding out the noise. So that's what we're going to do right now, actually. So if any of you are at retirementplanb.com, then we're going to head over to the second segment where we're going to be reviewing the 5,000 years of monetary history. In there, we're going to be picking some of the top 2 questions. So Azad, he will be picking out the questions. What you can do is you can opt into retirementplanb.com. It will then take you to a page where you can watch this. And underneath it, great ideas of questions there, and we'll be picking the top questions, and Azad will be joining us for a screen share shortly after the video. So if you want your questions answered, firstly, I really encourage you to watch the video, focus, concentrate, immersion, use this as your opportunity to really think about how you're going to be doing things differently next year, and planning out how you're going to be doing things with the Retirement Plan B as well. But you can get your questions answered there as well. So now we're going to head over to the next section, which is where we're going to be doing the 5,000 years of monetary history. So Dave, take away the next video.
I think we've
Egypt,
the screen is
5,000
actually
years ago, when gold naturally became the chosen form of money.
Zoom.
After gold came coins, where kings and governments took the responsibility for creating a country's currency, which was often made out of hard commodities like gold and silver. Banks were formed later as safety vaults to help people store their commodities like gold and silver. Paper currency started to form in China 3,000 years ago, where paper became the chosen form of money convertible to a set amount of gold. Whenever you deposited your gold at a bank, the bank would issue you with a paper receipt for your gold. Eventually, these paper receipts became as good as having the gold itself, and people started to trade with them. It was a natural progression, as gold is so hard to store safely and paper was more convenient to trade with each other for goods and services. As more and more paper started trading, banks started to issue receipts for gold on gold they never had, and they even started to lend these receipts for gold to borrowers. In effect, they were creating money through paper receipts of gold out of thin air that never existed. This led to many bank runs and banks going out of business when everybody tried to claim the gold they thought they were entitled to but never existed. Because governments wanted to prevent the instability of those bank runs, central banks were born in order to bring more stability to the banking system. Central banks around the world became the lender to governments and later increased their role to preventing bank runs by becoming the lenders of last resort to the banks. Central banks held reserves in currencies, gold, and government debt so that they could support confidence in the banking systems, as so many laws were passed that allowed banks to create more and more money than they had on deposit through legal changes and regulations. By 1913, a US central bank was formed called the Federal Reserve, and it was granted power to create paper money called Federal Reserve notes. The catch was that these Federal Reserve notes had to have at least a 40% gold backing. In 1929, excessive borrowing in the US for stock market speculation led to what later became known as the Great Depression of the 1930s, where bank loans were used to fund stock market bets. And when the market crashed, the loans destroyed the supply of money. The 40% gold backing meant that governments could not recover the economy by printing more Federal Reserve notes like it does today. In fear of the crash, people stopped spending and relied on their gold savings to protect their wealth. Because everyone was focused on savings, in 1933, President Roosevelt forbade the hoarding of gold within the United States and made gold ownership illegal. All US citizens had to deliver any gold they owned to the Federal Reserve in exchange for $20.67 in Federal Reserve notes. At the time of this recording, gold is valued at approximately $1,700, and the purchasing power of the Federal Reserve notes has dropped 95% over time. The Federal Reserve did well, but the American people got an awful deal. In 1944, at an event called Bretton Woods that was held in New Hampshire, United States, an agreement was negotiated that fixed $35 of currency to 1 ounce of gold. Other currencies pegged their value to the US dollar at a fixed rate, and private US banks were given full authority to create digital dollars backed by its nation's debt every time they issued a loan. Gold held at central banks became a sort of regulator on international trade and currency valuations, as bad policies meant that a nation would lose its gold reserves to another country, and they would need to adjust how much currency they were creating through their banks and balance their debts. Naturally, money went more and more digital, and the process of creating money by banks backed by debt ballooned out of control. Banks were given legal privileges to create as much money as debt as they needed, and the central banks agreed to implement policies to try and keep the financial system stable and working. Unfortunately, the opposite happened. Central banks ended up creating boom and bust cycles, and banks ended up controlling all the world's money and assets due to their special privileges to create digital currency whenever they issued a loan. Through law and regulations, banks became the legal owners of all deposits held at their bank. They were able to use these deposits as collateral to issue further loans and benefit from the interest on newly created digital money. They were also given the legal privilege to create new digital currency every time they issued a new loan. This meant that the modern bank can now create money, own your money, and spend your money, making it one of the most profitable, privileged, and powerful businesses in the world. In order to prevent the US losing control of all of its gold that it bought at low prices from its citizens and losing them to foreign countries, in 1971, currency took the modern-day form when US President Nixon removed the convertibility of dollars to gold, and we moved to a full US dollar debt-backed standard. This announcement was referred to as the Nixon Shock. The digital dollar, pound, euro, or any fiat currencies that you see when you log into your online banking today is now created by a bank every time somebody agrees to borrow it. If you fail to repay that loan, they repossess any assets you have, such as your home. Through this privilege, the banks have the ability to benefit from the world's largest rich-poor divide in history. This has led us today to record wealth inequality through debt. This problem accelerated when the system became increasingly more complex. The more complex the financial system got, the more systemically risky it became. And to make things worse, during the very time when people should be more diligent than ever, the average person got more and more detached from their money and financial planning. Everybody gave the management of their money to the same people that got paid when creating more and more complexity into the system. And as the world went more and more digital and global, currencies became tools for political control and are today used to launch hidden currency wars on other countries. The complexity of the financial system now leads to booms, busts, wealth inequality, financial crisis, distrust in the system, and markets that have no foundation in reality. And during that time, it becomes so complicated that you end up giving all your money to experts through pensions and managed funds that may not have your best interest in mind. When President Nixon removed the gold standard once and for all in 1971, this led to a huge debt bubble. Consumers took on record levels of credit cards, student loans, and mortgage debts. Corporations issued huge sums of debt by selling corporate bonds and using that money to buy their own stocks and push up their prices. Governments always increase their levels of debt to fuel economic growth, and debts became the main driver of a country's growth as debts and the complexity of the financial system went exponential together. Debt-led growth created banks that became too big to fail. They had it all. They create money every time they issue a loan, and if you default, they keep your assets. It gets worse. If they make irresponsible loans and get in trouble, they take all of those irresponsible loans, package them together into another complex product, and sell them to your pension, as they did leading up to the 2008 financial crisis. And it doesn't end there. If the bank has any risk left over after selling the loans to your pension, it turns out that they can request taxpayers to bail them out again and pay their high salaries and bonuses as they did in 2008. They can even exercise another option, which is to just simply take your deposits as they did in Cyprus in 2013 through bank bail-ins. And the insurance schemes that you hear about insuring your deposits, like FDIC in the US and FSCC in the UK, don't even have enough reserves to back up all the deposits they are insuring. To combat that, in 2008, Satoshi Nakamoto, the pseudonym given to the inventor of Bitcoin and arguably one of the greatest inventions of the internet, anonymously released a white paper that outlined a blueprint of how to create peer-to-peer electronic cash. Bitcoin was later launched as a parallel form of money that existed on thousands of computers all around the world that later became the largest distributed supercomputer in the world with no central point of failure. It existed on thousands of computers all around the world, backing up every record on what is known as a blockchain. In 2009, the first Bitcoin contained a permanent immutable message on the blockchain that read, "Chancellor on the brink of second bailout for banks." This message was referring to a UK government bank bailout that was funded through what is now known as quantitative easing, QE. QE effectively started in the last Great Depression of the 1930s, but accelerated in the 2008 financial crisis to prop up markets and bail out banks during a period of over-indebtedness. In a nutshell, because there is no gold standard and only a debt standard, QE has become a way for governments to borrow unlimited amounts of money from central banks who create it out of thin air. We now have $257 trillion of global debt, according to the International Institute of Finance. Inconceivable complexity in the financial system, and the US dollar now accounts for almost 70% of the world's reserves and over half of international transactions. In 2020, the Federal Reserve announced unlimited QE and made $6 trillion available to save America. My forecast is that we will need a similar monetary renegotiation as we had in 1944, where central bank digital currencies issued by central banks will be used to rewrite the rules of money. I believe that countries with the largest amount of gold will get a seat at the table during this monetary renegotiation, and Bitcoin will become a tool for smaller countries and central banks trying to get more power and a seat at the table. So I promised you the bare necessities of 5,000 years of monetary history to save you the 20 years I spent figuring this stuff out. The point of all of this was to help you understand how you can prepare for what comes next.
Okay, so we're going to take a bit of a pause and break there before we go into the outcomes of the different types of scenarios that you as an investor and me, when I'm building my retirement plan B, need to be preparing for. So just before we go into that, we're going to take some of the questions now, because I'm aware that we haven't taken many questions. So hopefully, Azad, I think it's now time to do a screen share and we can take the next two questions. So Azad, are you there with us?
Yeah, I think I don't think we're going to do a screen share, but I have some questions here for us. So let's go through the first one. I see a lot of people buying, what percentage of people across the world, do you reckon are actually awake to Bitcoin and what it really is?
That's a fascinating question. So thank you for that question. The first thing is that Bitcoin has been on an adoption cycle where, when I think about Bitcoin, as we said in the video, is money that you can own, money that you can spend, and money that has a fixed supply. Each and every year, more and more people learn that the money you can own, money you can spend, and money that has a fixed supply is more important. So when we look back in history, when I first got involved in Bitcoin, it was a bunch of people at the first Bitcoin conference. There was about 50 of us in the room, and we were all on the bank hater wave, as it were. We were all talking about how we can create something better than that exists in the banking system. So it was us versus the banks. And so it was a small community. I was involved in a community called the Monetary Reform Community that we mentioned. And each and every year from then, you had a separate use case that helps people understand that money you can own, money you can spend, and money that has a fixed supply is important. So back in the early days, there was some of the first early levels of adoption was when people were trying to contribute to WikiLeaks. And WikiLeaks got a financial blockade where it got censored by the entire financial system. Visa, MasterCard, PayPal, Bank of America. They started blockading all financial transactions for something that's perfectly legal but politically motivated. And so they started accepting Bitcoin, and that was obviously a very wise move for WikiLeaks, but it was the teaching people that owning, being able to spend in a peer-to-peer, less censored way means that you can leave law enforcement to do law enforcement, but you don't create the financial institution in the middle and then make them do all of the job of law enforcement. Then you had other use cases that came along. So you had Cyprus in 2013 had the bank bail-ins. And people all around the world in Cyprus started to discover, oh, the money that I have a bank is not mine. It's actually the bank's, they legally own it, and they promise to repay me, but if they take the wrong risks and credit risks, then the bank money isn't actually mine. Then came along Indian demonetization, for example, where it became illegal to hold certain denominated notes. And they tried to wash everything in India through the banking system so that they could digitize the currency and follow the world's largest regulated Ponzi scheme called the pound and the dollar and the euro. And then people were standing outside in the streets with cash trying to get it into the bank because those notes were going to be worthless at a certain point. And people started to realize the value in having Bitcoin. More recently, as the money supply increased, and we're going to be going through some of the stats of what has changed since the last time we created, since the pandemic broke out in terms of money supply, so that you can analyze and have a look at some of these things now. But as people start to really fear inflation, so today was the announcement, 6.2% inflation is the record spike in inflation for 30 years. So as more and more people discover that, oh, you can't just print money forever, it does have an impact on prices. Creating money as debt does mean that you've got to factor in all the interest repayments into the monetary system, and printing money recklessly is something that actually has an impact on the general price of goods. So, long answer to a question. There is so much more adoption. The vast majority of people now today, every time I say this, it goes bigger and bigger and bigger. But I always used to say that the vast majority of people still think that Bitcoin is a Ponzi scheme, a currency just for drug dealers, a get-rich-quick scheme for fiat thinkers. And actually, later when we do the content, I'm going to go through the 7 reasons why people don't buy Bitcoin, and so that you can analyze the risks, whether it be quantum computing, whether it be government bans, and all the common reasons that people don't buy Bitcoin. But as people discover more and more, so I'm going to answer that question a lot more when we cover the 7 reasons in this masterclass that people don't buy Bitcoin. So we are still at the early adoption phase. We went through retail adoption. We went through use cases. In the last year, it was about corporate adoption. We still got the ETFs, which is exchange traded funds. That means now pensions and institutions can purchase in a way that's still compliant with their regulatory requirements without having to worry about who steals the private key in an institutional or pension structure. We've had custody services. So there's still the mountain of institutional money to go into the financial markets. We've only had a Fugazi ETF, a fake ETF, where it's backed by futures, fake contracts in the financial markets. And we've still got Bitcoin-backed exchange-traded funds. We've still got the wall of institutional money. And remember, the reason that Bitcoin exists is because it allows you to own your own money, spend your own money, and have a money supply that's fixed. That is completely different from every other cryptocurrency. So there is still a mountain of people to learn each and every year as we get new adoption. Still in that, at least now we're at the phase where almost everyone in the world has heard of Bitcoin. Never thought we would get there this soon, but it's amazing how we have. Okay, Azad, we'll do one more question.
Okay, if we want to make a purchase of some sort, how do we cash our Bitcoin in order to make those purchases in the UK?
Okay, so again, fiat thinking here, and this is the separation. So the principles that we go through, and I go back to my financial planning days. Remember, I can't give financial advice. You need to look into your individual situation. But depending on the financial goals that you set yourself, and one of the things we do with everybody and the Retirement Plan B Online Wealth Management Program is they get our spreadsheets, we work through their balance sheets, we work through their cash flow statements, and then they set the asset allocations of exactly how much goes for when they're going to be taking money out of their investment accounts, separated from their individual savings and separated from their security and separated from their investment that benefits from a massive compounding effect. And so really, I can tell that you haven't been through that exercise just by the nature of the question, because you're conflating your investment funds with spending money without planning at what length of time. So we do spreadsheets that put together forecasts, and then you can get and pin down to the day when, if Bitcoin has performed like the past, and obviously the future doesn't equal the past, how long it would take till you could achieve certain financial goals that you set for yourself. Then you have that there, and you need to have a crypto-friendly bank. So that's one of the things we also focus on in 10 protections. If you were watching the pre-launch content where we covered the 10 protections, and don't worry, we'll be covering them, going a lot deeper as well. One of the protections is making sure that you are with a crypto-friendly bank. If you're working with a UK bank that is one of those clearing monopolistic cartels, then they are going to censor your transaction whenever it comes from a cryptocurrency exchange. So you need to put a bit of a plan out there on working with crypto-friendly banks, and that's one of the things that we would certainly work with as part of the wealth management program. So I think that's the first 2 questions that we've taken. Keep upvoting other people's questions. If you would like your questions answered, then make sure you head over to retirementplanb.com, opt in, and then underneath this video, if you're watching at retirementplanb.com, you get to upvote other people's questions and answer your questions, and we'll be taking the top ones, and towards the end of this, answering as many as we can. But now it's time to dive into the second and next part of the content. We now want to analyze what has happened since the 4-part video series in terms of the 4 seasons. So let's head over to the 4 seasons, and then we're going to look at some of the headlines and many of the forecasts that were made during the 4 seasons video, and look at what happened during the last year, and more importantly, give you a framework for how to think about what comes next. So let's head over to that video, and I'm going to go over to the screen share.
I hear you ask, how the hell is anybody meant to plan their financial affairs in such a time as now? Great question. In this free video series, I am going to answer that very question. I believe the only way to do that is to prepare yourself for any outcome, as this one is 100% politics. What the global politicians and central bankers negotiate could lead to runaway inflation in your country or other countries where the price of goods makes your currency worthless, as we are seeing in certain countries around the world today. The effects are devastating. It could also lead to asset price deflation, where some of your assets lose significant value. Alternatively, it could lead to another economic boom based upon a new debt cycle, or even a jubilee where certain debts are cancelled, killing savers and rewarding those in debt. It could also lead to a long period of economic decline and the Great Depression of 2020. My forecast, it will be a combination of all of the above, and you need to be prepared. I'm preparing for a Great Depression in 2020 that leads to asset price deflation, followed by a period of goods and services inflation, then an extended period of economic decline starting from the Great Depression of 2020. Eventually, economic growth will follow as the monetary renegotiation takes form. I'm also preparing for being completely wrong, as there is no way to fully predict the next moves of politicians and central bankers.
Okay, so I think that might have, oh, there we go. So the screen's not stuck again. We're having some challenges with the internet, getting screen stuck. Just let us know as that happens. Azad will get the attention and we'll try and fix that one as well. Right, so we talked about the 4 seasons. And so part of the retirement plan B approach is I want you to be financially unshakable. So when I developed my retirement plan B, it was all about preparing for every outcome. So let's have a look at some of the things that have happened. Some people were writing to me after the Great Depression of the 2020s 4-part video series, and they were tweeting me on @SimonDixon Twit saying, oh, stock markets are all-time high. Does that mean the Great Depression of the 2020s didn't happen and you were wrong? Well, not quite, because the Great Depression of the 2020s turned out to be all 4 seasons in one go. So let's have a look at some of the headlines and some of the things that happened on a global scale. So here's the headline today. So you can tell that we're live because this is hot off the press. The US has been had a 6.2% transitory inflation rate. And so this is really, completely off the scale in terms of what they were saying and the goals that they set for themselves in terms of thinking that the money printing wouldn't lead to this inflation. And remember, this is the inflation figures that the politicians are willing to report to you. The actual figures based upon reality is how we can all feel in our everyday life. We all know that things are getting more expensive. We all know that it used to take one person to run a household, and now you have to take 2 people to run a household and put out the children to work and put everyone and get 2 jobs and start working online, and you multitask 3 jobs at the same time in this freelancer-led economy so that you can just make ends meet in an environment of rapidly increasing price levels at certain parts. And so here's the key thing. People think inflation is just this one figure. Some things are going up, other things are going down. So when we're preparing for all seasons and the way the retirement plan B was designed, and when we go through it again in Masterclass 3 and the exact breakdown of how I invested over the last year in the retirement plan B approach, we were preparing for all of these seasons. Now, the reason that I was looking to prepare for all these seasons is because I was forecasting this in a book that I wrote over a decade ago called Bank to the Future, Protect Your Future Before Governments Go Bust. We were talking about the impact. So looking at the slides we got consumer good inflation and we got asset price inflation. We saw stock markets reach all-time highs based upon, look at the S&P. The S&P 500 became the S&P 6, where technology companies led the wave, led the charge. We had $2 trillion companies, whether it be Apple's and Tesla's, but all technological-led growth that we saw in asset prices. The money that was printed made its way into propping up asset prices. So we moved away from free market corrections to an environment where central banks do not let markets correct themselves into fundamental reality. A really important mechanism of markets is that you let the markets correct. So if no one can afford real estate and property, then you need to let the market crash itself, correct itself, and allow it to be more affordable for those that are not on the asset price ladder yet. This led to ginormous wealth inequality, where we had asset price inflation and we had consumer inflation. So those that have been using the debt markets to get credit card debts, to consume, got a double whammy that led them into one of the largest wealth inequality gaps we've ever seen in human history. That's because they were taking debt and they were purchasing goods that were getting more expensive, and asset prices were becoming more and more expensive as well. So rents were going up from those people that were on the right side of the asset price. So if you were on the wrong side of the debt cycle during this time, then you had the double whammy of consumer price inflation as well as asset price inflation without owning those assets. What else did we get in terms of the four seasons? Well, we had technology-led deflation. If you read my book, and last year I decided my publisher of this book actually has never paid me. He's pocketed all the money, but he's doing, and so we actually decided to give it away free to everybody, the downloadable PDF. We'll also make sure that you get that link if you make your way to the end of this video series as well. But in the book, I talked about this thing called a debt trap of freedom. And the whole chapter was dedicated to what I call the free economy, the open source movement. And we were talking about how everybody would lose their employment contracts, move to freelancer and contractor-led roles, and join teams, and end up with technology-led deflation. So the only reason that even just the minuscule 6.2% relative to the money that was printed is a figure that they're reporting is because technology is eating everything and driving everyone to free. So we've all been locked up in our houses, we've all been consuming more and more technology, and that is driving the price down towards free. And so the debt trap of freedom was a debt cycle that led to the technology-led deflation. So we got inflation, we got deflation, and we also got certain levels of different markets. So the crypto markets now became a $3 trillion market. Now, a bunch of that is things that will get wiped out during the next bear cycle, but a $3 trillion market led to ginormous crypto market growth as the world started to adopt Bitcoin and realize that companies needed money they can own, money they can spend, and a hedge against inflation. Institutions realized that it was probably one of the only games in town in order to normalize their alpha and their hedge funds when someone else like Paul Tudor Jones, one of the most successful hedge fund managers, and Ray Dalio gets converted over to Bitcoin. They all started competing with each other because all of the returns were being made in the Bitcoin industry. And now banks get on board and they realize they have to jump on after trying to get rid of Bitcoin and call it blockchain. And now they're all Bitcoin as well. But I talked about these trends in terms of the growth of financial technology. So we had record valuation increases on companies at BnkToTheFuture. If you were an investor investing in financial technology, we had the crypto and Bitcoin market reach all-time highs. And so you had a booming market. At the same time, you had countries that went into hyperinflationary, disaster situations where people had very good jobs and their currencies were destroyed by their monetary policies and their central banks. And if you don't understand and appreciate how disastrous it is when your savings get inflated away, just start to look at some of those countries that went through the complete destruction of their currencies, and middle-class educated people that were, just wiped into over 50% levels of poverty in certain countries as a result of not really focusing on the money supply and how money is created. So we had the crypto market and technology-led growth. And at the same time, as we said, we had the bear market as well. So what was really interesting about the Great Depression, what have we got here? And obviously, if you owned a small business and that business was a high street, then the pandemic drove you into a real disaster, economic declining situation. Here we go. So I talked about that in the book, Bank to the Future. I'm surprised myself how relevant it has become even a decade after it was written. So debt-led Great Depression, where you have the wealth inequality, those who are on the right side of the wealth gap were benefiting from asset price inflation, but consumer price inflation was also there. You had technology-led deflation that was causing a counter, and you had a real Great Depression in the high street. So what was the Great Depression of the 2020s? It was inflation, it was deflation, it was economic growth, and it was economic decline. And you had to speculate your way through that. And if you were on the wrong side of that change, then you had the financial consequences that caused this ginormous wealth inequality, where only information and education and putting into action some of the things that you learned here. And I was really delighted that we released that video series, and I got so many messages from people that implemented just what they learned in the free series, as well as working with the 500 on the online wealth management program, that they were protected, they were unshakable, they were prepared for all these different eventualities and outcomes. So that was the Great Depression of the 2020s. And now we're going to go to the final section where we're going to be reviewing some of the fundamental principles and how the portfolio performed in the final video. So I'm going to head over to the screen share, and we're going to cover the 3 fundamental principles that we covered last year, and that wraps up the video series. So Dave, over to the screen share.
But to round this video off and prepare you for the next 3 videos, here are the 3 fundamental principles that you need to take away and that I use to make up what I call my retirement plan B approach that I will be sharing with you in video 3. It comes down to 3 simple principles that you need to understand when planning your financial affairs during the Great Depression of 2020. Principle number 1. As the world owns, lends, and borrows US dollars more than any other currency in history, and due to the fact that the US gets a seat at the table during the upcoming monetary renegotiation because of its gold reserves and power, part of my retirement plan B is built around a strengthening of dollars and dollar-denominated assets. Retirement Plan B prepares you for US dollars continuing to be at the center of the global financial system. Principle number 2. Gold has a more important role today than most think. It becomes increasingly more important during a shift in currency war power and the disastrous effects of hyperinflation that can arise from bad debt and monetary management by governments. For this reason, gold is an important part of a retirement plan B too. Retirement plan B prepares you for gold being important when the US dollar experiences troubles. Principle number 3. If you don't hold physical gold close to you, then you may never be able to access it when you need it the most. A financial system that still works during a bank failure and can be used digitally with your wealth stored close to you in your control becomes important in times when you can't get hold of your physical gold that most are storing in Switzerland and Singapore. Retirement Plan B prepares you for Bitcoin being important when banks fail and you can't get hold of your physical gold. So the foundation knowledge is now complete. Dollar-denominated assets, gold and Bitcoin will all be explored further in the rest of this video series where we focus on how to prepare and what I'm doing. To bring this back to you, in video 2, I'm going to share with you what the greatest investors and highest profile Bitcoin figures in the world have done and what the lessons and mistakes I believe they are making are. We will cover Warren Buffett, Peter Schiff, Ray Dalio, Paul Tudor Jones, Robert Kiyosaki, Tone Vays, and Roger Ver. In video 3, I'll share with you how I will put together a traditional portfolio that works in inflation, deflation, rising economic growth, and falling economic growth, combined with a retirement plan B designed to accelerate returns and prepare for every scenario. And then finally, in video 4, I'll invite you to join me to build a portfolio live that I will be doing with $1 million of my own savings, as well as how I do it if I only had an income and no savings, all live during the Great Depression of 2020. So I'll see you in the next video. Keep an eye on your email and remember to whitelist our emails so you don't miss a thing. Please leave a comment below, as I'd love to get your feedback, and once done, share this link with your friends and loved ones, as I believe everybody needs to prepare and have a retirement plan B during the Great Depression of 2020. A plan that will prepare you for many outcomes now and into the future. So for now, remember, no matter how bad it gets, you are alive at one of the most interesting times in financial history, and I want you to be on the right side of that change. I'll see you in video 2.
Saif, we can't hear you.
Okay, everybody, I'm back. Can you hear me now?
Loud and clear.
Excellent. Okay. We get through Azad, I think. Yep. Okay. I think we're back. So could you give us a little comment in the live chat if you can hear me now? We had comments that the IMF had taken us down. We had comments that it was the Great Depression of the 2020s crash on the Masterclass 1. And I used that opportunity to take a quick restroom break, and I muted my microphone, forgot to put it back on, because we don't want to have any disasters of the sound coming through that wouldn't have been very pleasant for anybody. Okay, all right, so what happened next? Well, the Masterclass crashed. Okay, let's see if I can get my slide changer working and I can get back in flow and motion. Thank you, everybody, for that, and thanks Azad and Dave for getting us back online. Okay, right. I'm going to go now, move over to my screen share, because what I want to do is go through some of these charts on exactly the results and what happened after the Retirement Plan B live masterclass, so then we can analyze the results that were achieved. So I'm going to jump over, and hopefully we don't have another technical disaster as I move over to the screen share.
Okay, so I wanted to move over to the screen share so that it's nice and clear on the charts and there's nothing in the way when looking at these things. So since the video, The Great Depression of the 2020s, I'm going to pull up what has happened since so that we can analyze exactly what happened next. And so to do that, I prepared 3 different charts so that we can subjectively look at how the forecast did, what happens next, so that we can then start making some decisions as well. So a few indicators that I've pulled up. There's plenty more that we could pull up, but I wanted to just get the key ones that I think are important when analyzing. And I've picked a few strategic dates. The first one was the 30th of December 2019. This is when the pandemic first started and the first cases were reported. The 2nd of December 2020 was when we first released the Retirement Plan B formula and the 4 3-part video series. And the 9th of November 2021 is when I put these slides together just before Masterclass 1. And so let's look at a few different indicators. The first thing is what happened to money. Now, remember the analysis. We are in a US dollar standard until we're not. So we look at the US dollar as the base layer to analyze what has been happening in the different areas that we discussed in the free video series. The first is the US monetary base M0. Now, M0 is simply the cash and coins, but it also includes quantitative easing. And so therefore it gives us an indication where you take away the amount of digital currency that a bank created and just look at the base layer so we can see what happened to the monetary base.
And we had a 53.61% growth rate since the pandemic, and we had a 25.44% increase since the video series. So we created half the amount of money at the base layer in this period compared to the entire history of the dollar. So that's an astonishing thing, and that was quantitative easing. So we certainly had the removal of free markets and massive intervention in order to make sure that the economy doesn't experience the correction that it needed. In terms of US debt, obviously the government took on a big chunk of debt. So the US debt went from $23 trillion to approximately $28.9 trillion. So that's a 24% increase in debt during this period, and a 5.46% increase since the video series was released. But that doesn't tell the whole story, because rather than just the government taking on the debt, the the Federal Reserve, to accumulate all of America's assets. So its balance sheet went from $4.1 trillion, and a balance sheet just means the amount of assets that the Federal Reserve owns that it has to report. And this increased to approximately $8.5 trillion since the pandemic. That means that the Federal Reserve increased its balance sheet by over 100%, which it added more assets to its balance sheet than the entire history of the Federal Reserve since it started in 1913. And then it added another 17% to its balance sheet. So this is sucking up the world's assets and putting them on the Federal Reserve balance sheet. What happened to interest rates? Well, interest rates determine the cost of borrowing, and they were approximately 1.75% in December, and then these were slashed down to 0.25%. So the reward for saving in fiat slashed by approximately 85.71% decrease to disincentivize people to save, so that they can increase the amount of money out there, the level of indebtedness through the bank's digital currencies, the digital version of the dollar. And so slashing interest rates was their way to do it. Now, it's now reached the stage where those interest rates just simply cannot be put up without causing some kind of deflationary spiral, stagflation effect. So what happened to US inflation? Now, remember, this is the reported version of inflation, not necessarily the real version of inflation. But let's be, less skeptical and take the actual inflation rates that are reported to us. Well, it went from 2.3% to 5.4%. So we had a 134% increase in the inflation rate since the pandemic, and 285% increase since releasing the 4-part video series. So certainly, in terms of the inflation figures that were reported, the economy, the Great Depression of the 2020s, chose inflation and money printing through quantitative easing, increasing the level of indebtedness of the US government and the Federal Reserve as a way of pushing up dollar and dollar-denominated assets. And so what impact did that have on the assets that we discussed? Well, let's look at a few more things. So firstly, we need to analyze where you as an investor, if you put your money in various different assets and various different things, what type of income could you have received on that? And then we'll look at the increase in the price. So we call that in financial jargon yield, in terms of what income you receive, what interest rates, what APY or annual premium rate, annual premium rate per year, lots of different names and all sorts of jargon for the same thing. But we've taken those, we've looked at since the breakout of the pandemic, and then also you can see that if you had left your fiat at a checking account, a dollar denominated checking account, you would have received 0.3%. If you had left it in a savings account, 0.6% on average.
If you had left it in the money market, so it's where it invests in lower risk assets, then you would have received 0.9% on average. And if you had put it and lent it to the government for a 10-year bond, you would have received 1.57%. That's what the rates were there. If you had put it and converted it into a crypto US dollar denominated stable coin, then this number, take it with a pinch of salt, because there are some companies risk adjusted that were offering, 25, 30% yield, and others were more realistic around inflation numbers. But on average, you could have earned about 10% yield at that time by converting it into a US dollar denominated stable coin and lending it out in the collateralized crypto markets. And for Bitcoin, about 4.51%, and ETH about 6.51%. So we need to take those numbers and adjust them for inflation. So if you left your dollars at a checking account, you lost 5.37%. If you left it in a savings account, you lost 5.34%. If you left it and invested it in more riskier money markets, then 5.31%. And if you lent it to the government, then you lost 3.83%. And if you put it in stable coins, you would have received 4.6% adjusted for inflation. And in Bitcoin, you would have received a negative yield because inflation was higher than the yield paid on Bitcoin. So it's 0.5%. But remember, with these, we need to factor in capital appreciation because they're not denominated in dollars. So that's what we'll look at next. And in ETH, you would have received a 1.11%. So as discussed in the video series last year, by having it in stable coins and ETH, you were able to achieve a real yield. But if you also had it in Bitcoin, ETH, you would have achieved the capital appreciation effect that we'll discuss. So what's important is factoring in inflation, rates, yield, and also capital appreciation. So your money at a checking account would have been worth $1,060, but adjusted for inflation, you are $946 approximately. If you left it in your savings account, you would be approximately $946.60 if you like to count the cents. And if you put it in the money market, it's $946. So if you lent it to the government, then $961. So everything in traditional markets adjusted for inflation would have lost you money. In stable coins, you would have received $1,046 if you invested $1,000. If you put it in Bitcoin, you would now have $10,301. And if you put it in Ether, you would now have $37,864. And all of these figures are adjusted for inflation, factor in the growth rate of the base, and also the yield that you could have achieved in that. So clearly, following the retirement plan B approach was the only way to survive the early stages of the Great Depression of the 2020s. Everybody in traditional markets lost money. So what happened next? So now if you had taken that and you had realized that, putting money just in simply trying to beat inflation meant that you had to speculate. And so that meant that you had to reallocate your money and savings and put them into some kind of asset classes. Now, the assets that we discussed in the 4-part video series and in Masterclasses 2 and 3, we'll be reviewing the other videos and the different strategies as well. But this is just to give you an indication of what happened. So we've got those key dates as well. So this is where it's really interesting for the context of Masterclass 1. Now, if you remember, at the time of releasing the free video series, everybody was thinking exactly what people are thinking right now, that the price is too high. I've missed the boat. Have I bought the top? And all of the psychological triggers that stop people buying that we're going to be covering later in this masterclass. And so the exact same emotion that people are feeling now is the same emotion that I've seen people experience for all of the last 10 10 years and a decade since being involved. So your Bitcoin, and since the outbreak of the pandemic, Bitcoin was priced at 7,194 at the release of the 4-part video series where I shared how I'm investing $1 million of my savings publicly for retirement plan B, and how I would do it without savings. Bitcoin was valued at approximately $19,000. And at the time of putting together this chart for the masterclass, is now valued at $67,000. So that's an 852% growth since the pandemic. And if you had invested $1,000, that would be with all of the growth factored into that time, that would be $8,322 instead of your $1,000. In Ether, you would have done even better. So remember what we discussed. We said you can use the wider crypto markets to increase the amount of Bitcoin. So if you did that, then you would your $1,000 invested would now be $36,700 approximately, which could have been converted into Bitcoin to increase the level of Bitcoin if you're following some of the different strategies in retirement plan B. In terms of crypto equity, we have to use a slightly different matrix. As the CEO and co-founder of BnkToTheFuture.com, since the breakout of the pandemic, with the portfolio was worth approximately $104 million on Bank to the Future across different assets held within our custody. That increased to 179 million when we released the 4-part video series based upon the prices. Now, remember, these are long-term assets, so this is not a fair period to be judging it upon because this is forced hodl, long-term, high risk, high return, and illiquid, so you don't get real-time pricing. But off the pricing that we had, that increased as of today to approximately 540 million based upon the price of the different stocks and shares based upon their last funding rounds and the growth of the sector. So that gave a growth rate of approximately 419%. So $1,000 invested would be worth 4,138 in paper value of those illiquid assets. The stable coins, obviously the dollar, they didn't crash. They didn't break their peg to the dollar. So they were just based in dollar. There was no return on that. But you have to factor in inflation. So if you just left it in a stable coin, you'd be in the same situation as the traditional financial system. Now, we talked about the crypto market producing all the returns. I think you can see by using the strategies that we'll be covering more in future masterclasses, all of the returns were produced by having a retirement plan B centered around Bitcoin. We then talked about, now in a bear market, you'd expect the crypto equity and stable coins to put more stability into the investment portfolio. This was all during a crypto bull market. So you'd expect the crypto assets to outperform the more stable side of the assets. Those would be a protection against a bear market when the bear market comes. We then talked about that as the US dollar is the dollar standard, then we looked at US dollar and dollar denominated assets, and we put together a portfolio for inflation, deflation, economic growth, and economic decline. And if you followed that, we can use the S&P 500, which is the 500 largest stocks in the US, as a benchmark. And that experienced a 44% growth, which is the traditional retirement plan A as a benchmark. But also that would have been stabilized out because we implement different asset classes, including commodities and various other things. So that would have been worth 1,400 after adjusting for inflation. So the $1,000 invested is actually adjusted for inflation as well. And then finally, you have gold. And if you invested in gold, it did exactly as forecasted. It provided that it beat inflation, and it was an inflation hedge during that time frame. So remember, gold is about protecting in the monetary renegotiation, and the dollar remained, the US dollar debt-backed standard Ponzi scheme remained in place because of the increase in the balance sheet of the Federal Reserve,
the increase in the monetary base through quantitative easing, and therefore gold fulfilled its role. But again, it's a security part of the portfolio that we'll be going through in future things. So that gives you an indication of the three charts that I wanted to go through in order to analyze what happened next. So now let's go over back to the big screen so we can go through the next section. Okay, so as you can see, retirement plan B was the place to be. Sorry for the cheese. So what else happened though? Let's take a look at the big screen as well, some of the headlines that came up. We had this new concept called tapering, which I'll translate to you, is the Federal Reserve giving up on free markets. And so they're trying to taper out and they're trying to gradually reduce their quantitative easing program, where they're propping up the real estate markets and the property markets using quantitative easing as the mechanism. And now they're addicted, the economy is addicted to, again, QE. And they're going to try and figure out how to taper their way out of that. So that's all that's propping up the traditional financial markets. We've seen this headline again today, added this one. We decided to choose a hidden tax, and inflation is a hidden tax. They choose inflation over tax increases because they know that politicians know that you can't get to the next political cycle and the next election cycle if you increase taxes. But they also chose direct taxes. So they went for billionaire taxes on unrealized gains. So the latest one, if you're a follower of me on Twitter, I gave some updates on the fact that there's a cycle that normally happens. You start with billionaires because it's easy to say, well, these billionaires will take their assets that they own. And Elon Musk tweeted out saying, what do you think about me selling 10% of my Tesla shares so that I can start covering some of those tax bills that billionaires now have to pay? Notice he didn't say I'm selling my Bitcoin. He said I'm selling some of my Tesla stock, my retirement plan A, rather than his retirement plan B. And so we started to see that those tax in here. And then you know the cycle that comes. It starts with billionaires because it's easy to get the vote and you get everybody to say, yeah, tax the billionaires. And then it goes down the cycle and it goes to the crypto millionaires. And then it goes down further and further. So the need for asset protection, which we'll be covering in Masterclass 3, becomes more and more important. So we had the hidden taxes through inflation, as well as the more direct tax increases on billionaires as well. We also had, as forecasted, the beginning of the monetary renegotiation. And the G7 announced that they're going to be putting together a partnership on their working paper on central bank digital currencies. Every single central bank around the world that's worth its weight in gold put together some kind of central bank digital currency policy. But the real smart central banks, the ones that haven't been announcing it, or the countries that started making Bitcoin legal tender, started looking at how they can accumulate Bitcoin as part of their balance sheet. Instead, the large incumbents started preparing for the monetary renegotiation as we enter the currency wars that we talked about in the video, and the G7 put together and laid the gauntlet. We also had the International Monetary Fund, the IMF, the World Bank, the Bank of International Settlements, the Federal Reserve, the Bank of England, and a ginormous list of central banks that follows to put together. So if you remember my forecast, the monetary renegotiation, these central bank digital currencies have nothing to do with Bitcoin other than they drive Bitcoin adoption. Most people focus on the fact that they're a digital payment rail, and then they start getting scared that when governments release their central bank digital currencies, they compete with Bitcoin and it will render Bitcoin worthless in the future. Nothing could be further from the truth in terms of my investment thesis in terms of how I'm investing in my retirement plan B, still focused on Bitcoin accumulation, because a central bank digital currency is not money you can own, is not money that you can spend. In fact, it will be artificial intelligence-led algorithmic tax collection that will determine whether you can spend that money. And of course, without saying words that will get us banned on YouTube, the government, any kind of agendas in terms of compulsory policies, you know what I'm talking about, that are being imposed upon people at the moment, they will be connected not only to your passport and freedom to travel, but also to your central bank digital currency as we move into this technology-led growth phase with central bank digital currencies. Also remember to be a subscriber to my YouTube channel whenever there's a broadcast that goes live, or I give broadcasts on Twitter at Simon Dixon Twit as well. Also, do me a favor, if you've been enjoying this live broadcast, we'd love more and more people. So we'd really appreciate you heading over to retirementplanb.com, hitting some of the social media sharing icons, and make sure that more and more people see it. We make it really easy on the sidebar for you to share so that we can get more people. Or if you're watching it on YouTube, feel free to do that. But remember, we're going to be answering the questions when we go to the Q&A section as well. What else did we see next? We are still in the US dollar debt-backed standard. So many of you might be fearing, and I perfectly understand the emotion, that you don't want to build a retirement plan A and you want to go all in on crypto, which is perfectly fine if that's your risk profile and what you've set for yourself. But my goal with retirement plan B was always to have you prepared for any eventuality. And so as I get older, I start thinking more about protecting against certain scenarios. And so as painful as it is, I still have the retirement plan A US dollar denominated portfolio, which is a bet on central banks taking away free market capitalism and implementing the monetary renegotiation, letting the banks go bust, and then replacing it with a central bank digital currency and moving fully to a more socialist, communist-led market environment. I still think that's a trend, so therefore I know that free markets won't let markets correct anymore, because free markets are being taken away. And so we are still in the US dollar debt-backed standard. So remember the thesis. The thesis was the returns are made in the Bitcoin retirement plan B portfolio. The central bank bet is in the US dollar denominated portfolio. And eventually the dollar becomes, as every single fiat currency in history has failed, gold becomes something that people flight to in safety and a hedge against a catastrophic failure in the crypto markets. So we still are in that, and therefore I have not changed my thesis, despite some of the successful investors that will go through in the second masterclass, stating that you need to be out of the dollar and you need to be into foreign stocks, and also giving advice like avoiding Bitcoin. You know who we're talking about, Peter Schiff. Okay, so what did we have for principle 2, still held, as it were, which is that gold still performed the role as a wealth preserver. Now, you would have seen the catastrophic figures of people that have held gold over the last 10 years. But remember, we do this as part of our retirement plan A. We have gold in through traditional dollar-denominated assets. But then we have it in our security bucket, which is Bitcoin, where we own the private key, and gold, where we can gain access to custody of it as well, to provide those extra layers of security. Sorry if I'm going a bit deep, because this will all make sense when we start doing masterclasses 2 and 3 as well, which build upon the layers. But we were just trying to give what happened since the forecast that were covered in the videos. And of course, covered it already. But the crypto market's now approaching that $3 trillion market cap. Another triple of that, and we're starting to approach an asset class and an industry that is larger than the 5,000 years store of value gold, which is an incredible achievement from this tiny little community of 50 of us at that first Bitcoin conference. It's just incredible to see this all come through. So I think now it's time to take some of those questions. I think a lot of questions have been building up. So Azad, let's maybe take a couple of questions And then I think after that, we're going to be hearing some of the case studies from the retirement plan, the online wealth management program graduates on some of the results that they achieved. So it's all very well me saying, here's what my portfolio did, but we're going to be making sure that you can relate to everyday people that joined the program, that implemented what they learned, and some of the results that they've been achieving over the last year since being involved in the program. And so we'll go over to one of those case studies as well. So Azad, should we take some questions now?
Yep. Is it worth trying to accumulate Bitcoin by trading altcoins or just buy and hold some large cap alts?
Azad, it might be better if you share your screen because it just moves over to that so we can see the questions you're asking as well. Right, so the questions of altcoins. Now, remember the approach, and we'll cover it more in Masterclass 3, that if you want to benefit from the growth of the wider crypto markets, then there's certain plays and there's certain risk profiles. Now, everybody knows that you could have made a ton of money if you invested in Dogecoin and Shiba Inu and all these crazy things that have come along. And if you want to allocate a percentage of your portfolio for doing that, then feel free to do that. Recognize that it's gambling. Everybody talks about their X 10,000% returns, but no one talks about all of the money that they lost on the shit coins that didn't go anywhere. So going into the wider crypto markets is something that's built into the strategy. But in terms of making that a core thing where you're selling your Bitcoin, it's got to be part of a real planned out asset protection and asset allocation structure so that you know these are the percentages and it's about Bitcoin accumulation and you set your goals around that. And so that's one of the really important things that we would work through when we're sharing all of our spreadsheets and working through balance sheets and cash flows so people can know how much that they can allocate towards those really, really fun gambling parts. And I do have a percentage that benefits from that. And also some of the lower risk approaches. Okay, next question, Azad.
Yeah, well, you mentioned Peter Schiff, so let's do this popular question. What's wrong with gold? Why doesn't it move up in price?
So gold is not designed to increase your wealth, it's designed to preserve your wealth. So when we go through the strategies in Masterclass 3, we talk about gold being a security bucket during the monetary renegotiation. And so gold really there's lots and lots of trends. So when the Bitcoin futures exchange traded fund, if you're not familiar with exchange traded funds, they're simply financial products that trade on financial stock exchanges and give you exposure to Bitcoin. Rather than owning Bitcoin, the Bitcoin futures ETF is backed upon derivatives contracts that layer on top of Bitcoin, that are also layering on top of that financial markets. And so what you saw is a big migration where there was selling pressure on the gold ETF and purchasing pressure on the Bitcoin ETF, which really puts that final nail in the coffin on Peter Schiff's thesis that people are not selling gold in order to buy Bitcoin and that the rhetoric that he's been talking about doesn't exist. Point blank proven that by numbers, you can see it, that the next generation are really thinking about, and more and more people are looking at how to accelerate their pension and retirement plans using Bitcoin ETFs rather than gold ETFs. Now, that doesn't mean that you go all in. Remember the approach. The approach is to put together an all seasons approach. And that's what we'll be going through when we go through the investment strategies in Masterclass 3. So Azad, let's take one more question and then we'll go to the next segment. And I've also got the 7 reasons that, and updates on the 7 reasons why people don't buy Bitcoin. We've also got the special sneak peek segment with Andreas Antonopoulos, where we pull out some of the content from the Retirement Plan B online wealth management program. And that will be just for the live. So after this, that segment will be edited out, and it's each of the sessions and the masterclasses will be having one segment and a sneak peek with some of the experts and mentors that became part of the Retirement Plan B program And so we'll have Andreas for that at the end. So make sure you hang around, and thanks to everybody that went through that. Right, we'll do one more question and then we'll go to the next segment.
Is it best to keep your Bitcoin at a place like Coinbase where it's purchased, or have it in a wallet that's in my possession?
Okay, so when we do protections, we talk about getting the right mix between what's known as custody and self-custody. Andreas is going to cover a bit of that from the content when we do the live viewer bonus as well, and we give you a little sneak peek on that. But Coinbase has a couple of wallets. One is called Coinbase Wallet, which is a self-custody wallet, and then there is Coinbase, which is a custody wallet. The difference is that you own the private key if you have it in a self-custody wallet, and you do not own the private key if you hold it in a custody wallet. Fortunately, regulations have gone leaps and bounds. So when someone is storing your private key, you want to be going with regulated custodians, because although there are very, very bad regulations like anti-money laundering regulations that don't protect consumers in any way and is code word for tax collection, there are very good regulations when it comes to centralized financial institutions in terms of custody, segregation of client assets, making sure that you have disaster recovery, insurance, contingency plans. And so going with a qualified custodian is one of those options. Now, what I like to do when we're working with the wealth management program is getting the right mix between hedging against you losing your private key, so that it doesn't lead to you losing all your Bitcoin, and also hedging against custodians that may be subject to disaster events. And most people, when they're using a service like Coinbase, they start with Coinbase and then they graduate over to gradually getting the security set up. And that's one of the bonus modules. We go through the whole security setup that people can use with the security experts like Andreas on making sure that you're ready for self-custody. And during that, it goes through a whole assessment on determining whether you're ready. And then we go through the approach for determining how much to put into custody versus self-custody. So that's one of the things that we can cover as well and answer more questions on that. Okay, let's move over to the next segment as well. So what are we on right now? Right, so the next segment is I wanted to, now that we have gone through the 5,000 years of monetary history, we've understood that the retirement plan B approach is all about building a retirement plan with Bitcoin at the center of it. There are some people last year, as we go through the case studies, and we'll be going through Michelle's story about what she did over the last year. I look forward to sharing that with you because it's a very inspiring story as soon as we saw it. But why do some people not get on board? And what I found is that it's normally because somebody out there is influencing your decision, and you get caught up in the news from experts that are giving you reasons why not to buy Bitcoin. And this has been the story over the last decade, and it's been a very expensive mistake for many. So I'm going to go through the 7 reasons why people tend to miss the boat. And there's a double meaning here. People think that Bitcoin is at too high a price, and therefore they need to start going further and further down the risk curve and start looking at gambling on all sorts of things. They end up in pumps and dumps, and they end up, over trading and creating tax events and creating all sorts of challenges for themselves. And so they consider it because they feel that they missed the boat in Bitcoin. But missing the boat is normally because you didn't buy, as opposed to the price going too high and then feeling like you're missing the boat as well. As I said, remember what we started at the beginning? For every single day for the last over a decade, I've received emails that think that they missed the boat, the price is too high, they can't possibly accumulate here. Okay, so let's look at some of the reasons why people won't implement this. And the first reason is volatility and the utility. So you hear people talk about, there's some of them left, in terms of some dinosaurs left that talk about Bitcoin having no intrinsic value. and they don't understand the value of Bitcoin. They think it's just a greater fools theory, and it's just a pump and dump and a Ponzi scheme, and you're just trying to get someone else to buy your Bitcoin for you. That's because they are fiat thinking. A review, we talked about the difference between fiat thinking and Bitcoin thinking. Bitcoin thinking is where volatility is good because the crashes allow you to accumulate more Bitcoin, and the goal of the retirement plan B is to get more and more Bitcoin to generate the returns. And during bull markets, we tend to move to fiat thinking. When we can see the dollar value of our wealth or the pound value of our wealth or the euro value of our wealth go up, we start driving into fiat thinking, where we start thinking about consumption, where we start thinking about whether we can spend it, and the things that we would like to buy. Now, don't get me wrong. I have one of the things we do when we work through people putting together their financial plan is to determine how much of Bitcoin, when they're going to remove from it, and actually plan that and what they're going to take out and how to benefit from compounding effects in both growth and income. And that's all built into the plan that people, that the graduates will set for themselves. And so that's designed to drive you away from that fiat thinking, but also what is life worth if you can't buy the things you want? And most people, unfortunately, in Bitcoin are driving to savings thinking. So it's very anti-consumption, anti-velocity of money, and why it's so controversial to many people. But in terms of what is Bitcoin's utility, I've said it for over a decade. If you follow my YouTube channel way back over a decade ago, when I was describing and speaking at the first Bitcoin conference, I said the utility is giving you the ability to own your own money, giving you the ability to spend your own money, and giving you the ability to benefit from the world's best shot at ever achieving digital, hard, sound money. That is the utility, and lots and lots of innovation has come along. We've had, obviously, Lightning Network that makes it cheaper to spend and various other things. We've had countries making it legal tender. So what do people need until they finally get in their head that there is benefits to owning your own money, spending your own money? I think it requires them having a central bank digital currency and them getting their passport switched off because they're integrated with the central bank digital currency. And then people are going to, more and more people are going to realize. The other one is volatility. And the way you combat volatility, as I said, is by exiting fiat thinking and moving into Bitcoin thinking, which is a psychological shift. Now, most people want strategies, and Retirement Plan B is all about giving strategies, but 80% of your results are actually psychology. And shifting your psychology in terms of to the trends that we're talking about, that we're playing on about here in the Retirement Plan B, is the trends that is a game of psychology, and that's why we focus a lot on that. Now, most people just want, tell me when to buy, tell me when to sell, tell me what to buy, tell me what to sell. And I can tell you that they're not in the mindset of being able to execute upon the longer term approach that makes this so successful for so many of the people that have now implemented it. So in terms of volatility, you have to, and we'll be talking about this more throughout. Remember, I said repetition is the mother of all achievement and all learning. So we're going to be repeating this constantly, this constant theme of getting out of fiat thinking and getting into Bitcoin thinking as the Bitcoin Retirement Plan B approach evolves. So volatility they use as a reason, but remember, when the price goes up, it drives you into fiat thinking. When the price goes down, it's the perfect accumulation if you're Bitcoin thinking. And that's a psychological shift that you will need to make. Reason 2 is the infamous government ban. This is a real risk, but in each year, it really was a risk in the beginning, especially when Bitcoin was, one of the main use case was buying drugs online. And the Bitcoin ban was a very real risk then. But now we've had a completely change in market. So the infamous government ban. So people say, well, central bank digital currencies, they're going to be competing with Bitcoin and making it worthless. Well, central banks don't have the use case and the properties of Bitcoin. Own your own money, spend your own money, and fixed supply that can't be changed by the whims of central bankers that's causing all the inflation and devaluation of your savings that we're experiencing right now. But the infamous government ban, we've got lots of, so let's take a look in Common Sense Corner and look at some of the history and what's actually happened. So firstly, the Bitcoin ETF is here. That decision cannot be reversed. What does that mean? Billions and billions of dollars of pension money and mutual fund money and hedge fund money, which is essentially mom and pops, which the regulators are meant to be there to protect. They tried to protect them from getting wealthy through Bitcoin for a long time, but now they capitulated at the end and allowed some of the traditional financial institutions to put together the infamous Bitcoin exchange traded fund, which now means that if the regulators decide and the government decides to put those outright ban on Bitcoin, they're going to be taking away many of the returns from people's pensions and that wealth effect that now is integrated into the financial markets, so that people, so the likelihood of the infamous government ban that everyone's so scared of that happened to gold during the last Great Depression, where people were hoarding gold and therefore they made in America gold ownership illegal, becomes less and less likely. But what if they do ban it? Well, let's have a look at what happens when countries ban. So firstly, it is all loaded up. Pensions, corporations, companies, public companies, they're all loaded up on Bitcoin now. Tesla's got their Bitcoin, and all of this happened this year. But what happens in the old adage, invest in everything that China bans? If you had $1,000 and you invested it in everything that China bans, you would have $6,000 from your Google investment, $9,000 from your Facebook investment, $22,000 from your Amazon investment, banned by China, banned by China, banned by China, $34,000 in your Netflix investment, banned by China, $159,000 in your Tesla investment, and $237 million on your banned by China Bitcoin investment. So why is China the central point? In 2013, China decided to make a strategic move to implement and allow on publicly controlled television documentaries in Bitcoin before any other government in the world. I believe that it was because they saw it as an attack on the dollar in the time. Since then, they have flip-flopped up and down, up and down, up and down, banned, non-banned, banned, on-banned, banned, on-banned, banned, on-banned. And that has driven a lot of the mining industry that everyone at the time was saying, you can't invest in Bitcoin. It's centralized in miner and all the miners are in China. And so you've got centralization. And we had early Bitcoin developers like Mike Hearn during the 2015-2014 hissy fit saying it's all centralized and it's all China controlled. So now China comes along and says, well, we'll ban the mining of Bitcoin and we'll launch our central bank digital currency. We have seen every single time that China bans Bitcoin, within 6 months, Bitcoin reaches all-time highs. I remember when I was on a boat in Shanghai during 2017, when the price of Bitcoin crashed down to $3,000 because China started arresting some of the exchange owners in China. And what happened? 6 months later, we went into the bull market that led us to 20,000. China recently decided that they're going to re-ban Bitcoin. We have the initial collapse, we have the initial crash, and where are we now? Back up to all-time highs. So it is all about in removing yourself from these initial fears and these initial headlines that drive you into selling your Bitcoin to the market manipulators that are willing to scoop it all up because you're focusing on the short term, trading the news, rather than focusing on the long term and the strategy that equalizes all investors, which is becoming an investor and following the sound principles that I try to share with everybody that have worked so well for me in the retirement plan B approach. So we've got case studies of Bitcoin being increasingly less likely to experience one of those bans, and case studies of Bitcoin reaching all new all-time highs when you have the most populated country in the world that people said all of Bitcoin is centralized within that country and it drives it to new all-time highs. So I don't want to take away the risk. There is still obviously a risk that needs to be hedged for, and that's why we follow the whole approach that we'll be sharing in Masterclass 3 and the strategies around getting the right mix between hedging for different eventualities. So what do we have for number 3? Reason 3 is the environmentalist. So Bitcoin consumes a tremendous amount of electricity. And so this came to the forefront during the last year when Elon Musk said and came along and revealed that Tesla, the company, is holding a bunch of Bitcoin. Elon Musk himself is holding a bunch of Bitcoin. And then they got this whole backlash from the environmentalists. And this is actually a real thing. It's very easy for people to poo-poo this as not that important. But institutional money, there's more and more investments driven by environmental concerns that is being implemented by rules and regulations that are dictating the flow of vast amounts of money. And so bringing this conversation to the forefront in 2021 was really done by Elon Musk and Tesla when he tweeted out to his 38 million people saying that we're no longer accepting Bitcoin until it gets to at least 50% carbon neutrality in terms of being 50% of the mining coming from cleaner sources. Now, China is obviously one of the countries that is one of the largest polluters in terms of non-clean technology. China drove all the miners out to other countries, and now all of this money printing and these trillions of dollars are being driven into investments in clean energy, and guess where that benefits? The Bitcoin is like a bug bounty, a bounty for rewarding the most efficient electricity usage in the world. And so now that you can regenerate electricity into building a financial system that is not backed up by guns and crime and force, which is the traditional financial system where laws say you have to use this currency, and Bitcoin is still being made in countries like El Salvador as legal tender, this is really driving much of the innovation in terms of the allocation of electricity and movement towards more efficient electricity. And if these trillions of quantitative easing money can result in much, much more efficient ways of generating electricity, then Bitcoin is the ultimate reward for creating the complete efficient effect. We talked about this a lot in the wealth management program. We had Safety in a Moose that the Bitcoin pricing module so that we can plan out when we're planning our retirement plan and when we want to take money out in order to spend. He was talking about this efficiency gains and research that he's been doing. Safety in a Moose is the author of the Bitcoin Standard, and the incredible amount of efficiency that can come from having this ginormous reward for being able to use the most efficient electricity. So the it's an environmental disaster thing, drove many people to sell their Bitcoin, and then Tesla and Elon Musk accumulated and said and kept those Bitcoins as a result of these environmental concerns. So, and we got the announcement. Remember, these are public companies. In public companies, you have to disclose your balance sheet. And the balance sheet showed that the environmental concerns were announced, but Tesla kept all of his Bitcoin. And that's because he's now working with a group of people and pushing forward those that are more concerned about the environmental challenges to be overcome in order to drive the next wave of adoption and institutional money that will, through regulations, can only be guided to more renewable energy and clean technology. We also saw, this is a report that we found out, that approximately this report, I'm not sure if I go to this because we've now got many initiatives that are looking into this, but this report said that 74% of the mining that's powering is done by renewable energy. I haven't spent too much time on fact checking that, so please do the fact checks yourself. But the environmental concern that now Bitcoin is the world's largest supercomputer in the world is now becoming more and more at the forefront of people. And there's this reward for Bitcoin mining, and it's been moved away from China and geographically diversified, making Bitcoin less and less centralized and moving away. Two of the biggest concerns about why Bitcoin's about to go to zero. I remember we did the Bitcoin Hard Talk show. For those of you that are veterans of the YouTube channel, I was trying to bring in as many people that thought Bitcoin would go to zero, including Jim Rogers and other mentors of mine in the traditional investing space, and debating those as well. So perhaps we'll bring that again back in 2022 and see what we can do. So that's the third one. Now I want to go through the final reason, which is not final reason, the fourth reason number 4, losing my head here. I'm going to go over to the screen share to cover this one because this one is one that I would really like to, the truth will set you free here. There's so much mythologies in Bitcoin and myths that people have that stop them from getting on board of what has been the highest performing asset class in history and one of the largest wealth distributions that we will see as the young generation that have got on board this industry, and you have the older generation that will be cashing in on their retirement plans and their pensions, passing that legacy on to the younger people. And where are the younger people investing? Well, they're investing in this industry and this sector. And so I don't want you to be missing one of those largest wealth redistributions that I forecasted in the 4-part video series as we move over to many of these monetary renegotiations. And one of the big ones is some of the technical shocks that the attacks that can be done. So you're going to hear about 51% attacks, quantum computing. I don't want to get really geeky. This isn't about getting as technical as we can, but I'm now going to move over to the screen share and we'll go through some of those technical attacks, and we'll put them in context in terms of probabilities and likelihoods of some of these manifesting and becoming a reality.
Okay, so I wanted to move over to the slide presentation and share my screen for reason 4 of why people don't buy Bitcoin and how to analyze whether you think it's an asset class worthy of a retirement plan. And that is technical attacks. And there's really only 3 main attacks that I want to cover here. The 3 that are most common. And I don't want to go too deep into the technicals. I tend to divert to other experts when it comes to the technical. I'm a finance guy that found technology, but everything's gone technology. And so I just want to give you an appreciation for the different types of technical attacks. So in this section, without getting too geeky or too technical and boring you to tears, I want to cover the 3 main attack vectors that most people use as a reason for not buying Bitcoin and certainly not putting it in their retirement plan. And this way you can analyze whether it is a feasible, if you agree with that and the likelihood, so that you can decide where to focus your time and energy and analyze the risks. So the first one is the 51% attack. The second one we're going to go through is the quantum computing attack. Whenever you hear the people that are criticizing Bitcoin, you'll talk about, oh, it could be 51% attacked, it could be quantum computer attacked. And then the real one, which you should concern yourself, which is personal attacks. So we're going to jump straight into each 3 of those to understand reason 4 why people don't end up buying Bitcoin and miss the boat with their Bitcoin. So let's help you understand a bit about 51% attacks. The first thing to point out is I do have direct experience of what happens when it becomes close to a 51% attack happening on Bitcoin. Way back in 2014, there was a company called ghash.io, and they became close to controlling over 50% of the mining power through a mining pool that secures the Bitcoin blockchain. And so this was a real example of what happened. And immediately, as soon as it started to approach the 50% mark, miners all flocked to different mining pools. So if you're not too familiar with the mechanics of Bitcoin, miners are the people that verify every single transaction. And if one individual miner or mining pool gains over 50% of the mining power, then they could theoretically perform a 51% attack, which I'll just go briefly into. And so really the attack, to help you understand, is that once you own more than 50%, there's a rule in Bitcoin called Nakamoto consensus, where the miners have to accept the heaviest chain. Now, I don't want to go too geeky, but once somebody could achieve that, then theoretically what they could do, and we know this from other coins because it has actually been done when you have less secure coins that don't have the vast, largest supercomputer powering them, which is Bitcoin, the largest distributed supercomputer in the world, and all the security behind it, and why people talk about the environmental side with Bitcoin, which we've already covered. So what they could theoretically do is, if they could gain over 50% of the mining power, then they could send some Bitcoin to an exchange. And this is how attacks have been performed with other coins that are less secure than Bitcoin. And then they could go to that exchange and they could exchange their Bitcoin in for some US dollars and withdraw those dollars. They could then broadcast the chain that does not contain that transaction. And so the transaction where they sent the Bitcoin to the exchange could not be broadcasted, and they can do that because they are running a chain that contains the heaviest blockchain via Nakamoto consensus. And then you have essentially rewritten history, and you have the original Bitcoin that you sent to the exchange that you took out of the chain, and the US dollars. You could also maliciously use this in order to cause disruption to the Bitcoin blockchain. And that's why the security and the hash power and the size of the computer network behind Bitcoin becomes very important. So only Bitcoin has enough security to make this completely infeasible and too expensive for most actors, with the exception of a country or a government or a state actor that wanted to burn an incredible amount of money. To give you an idea of how long it would take, so in Bitcoin, without getting too into the economics of Bitcoin, every 2 weeks, approximately 2 weeks, there is what's known as a difficulty adjustment, which is where, based upon how many people are mining and how many miners there are and how much computer power, it adjusts how difficult it is to verify and find the Bitcoins, the economics of Bitcoin. And every 2 weeks that adjusts. So to perform a 51% attack, in theory, you would need to be performing this up until the next for a 2-week period. And so based upon the mining power, the more mining power behind Bitcoin, the more expensive it is. There's a website that you can use. So this was in 2014 called I'll go through that right now. And on this website, which is crypto51.app, I'll just give you a quick screenshot in a bit. Based upon the time of recording this, it will cost you approximately $2.7 million per hour to perform such an attack, up to 2 weeks in order to do that. So we're talking about an incredible amount of money. And if you want to actually do this, head over to crypto51.app and you can see how much it would cost per hour based upon their estimates for Bitcoin and other cryptocurrencies, and you can see the vast difference in those security models. The cost, it is only really feasible by some state actor that wanted to cause a nuisance to Bitcoin, and nobody has successfully done that. In order to do that, you would need to be burning the electricity of essentially a medium-sized country. You need to be buying up millions in hardware equipment, so it would be very easy to detect who's doing this. And then if you wanted to perform a double spend, like we gave the example, you need to be sending millions to exchanges. So as we said, it's only really feasible by a government or state actor for malicious reasons as opposed to for profit reasons. And even then, the nuclear option would be to adjust what's known as SHA-256, the
the algorithm that is used, and you could adjust the proof of work function behind it. It would be a nuclear option, however, because that would render all mining businesses bankrupt and they'd have to invest in new equipment. But that is always an option if it went to this stage. So that is really the feasibility, and there's a lot more to it as well. But have it be known, it's a very hard attack to perform, it's very expensive, and it most likely wouldn't go unnoticed, and the community could adjust to it. So you can take that as a reason not to buy Bitcoin and not to own your own money, spend your own money, and benefit from the growth of the world's best shot at achieving digital hard sound money, and assign some probabilities to it. Let's look at another attack vector, which is quantum computing attack. So this is the attack of developing a supercomputer that is so powerful that it can guess your private key, which is what controls whether you own Bitcoin, and break the SHA-256 encryption that Bitcoin relies upon. Just to give you an idea of how disruptive this would be if this quantum computer existed, it wouldn't just affect Bitcoin. This would affect most passwords, online banking, governments, the same systems that governments use, as well as the banking and financial system, and nuclear power plants and all sorts of stuff. So this really does break everything. So it would be a nuclear option should such quantum computing attack exist. So once we understand that, we can assign a probability to that likelihood and whether they would waste their time on using it for Bitcoin, because at the end of it, if you performed any of these attacks, you would end up with a valueless network, an expensive and complete disruption of all sorts of systems as well. So to give you an idea of the likelihood of this happening based upon the way Bitcoin is designed and the SHA-256 encryption that makes it called a cryptocurrency, it's the equivalent of winning 9 national lotteries all in a row. So not only do you have to win one national lottery, but you have to do it 9 times in a row. Really, if you want to, the nuclear option really ties into why we actually have in our retirement plan B protections against, drastic changes like such very low probabilistic attacks as well through owning assets like gold. But I want to show you the chances of this actually happening. So if you were to do this, the quantum computing being able to crack the code, they'd have to invent a computer that has the power whereby the odds of this would be 1 chance in, ready? 1-579-208-923457099878907-85326998466556039454575884009639993. Fancy those odds? Well, this is why people are not buying Bitcoin, because they're concerned about an attack on from a quantum computer that would exactly attack everything else. So if you wanted to do this, and I'll just give you one crazy example from a great post that I found on Reddit that really puts this in context. In order to perform this quantum attack, I've got 51% attack here, but it's a quantum attack. You would have to have a supercomputer that fulfills the following thing. Here's a metaphor, I'll quote. If you could use the entire planet as a hard drive, storing 1 byte per atom, using stars as fuel, and cycling through 1 trillion keys per second, you would need 37 quadrillion Earth to store it, and 237 billion suns to power the computer capable of doing it, all of which would take up to 3.6717 octadecillion years in order to achieve it.
And that's a quote from P.S. Blake. I have no way of actually verifying that, but the article was very, very detailed, very, very in depth. And you can look that up on Reddit. So these are the probabilities. So people don't get on board and miss the boat of buying Bitcoin because of these 51% attacks and quantum computing. So analyze the probabilities of the risks from where we are right now. And the final attack in reason 4 is personal attacks. Now, this is something very real. You do need to learn how to personally protect your funds. Now, the good thing here is, the good news is that when we work with our retirement plan B clients, we go through about 3 protections and the simple things that cover about 90% of it. And these are the skills that you need in the modern age anyway. Now, having Bitcoin means that protecting your money makes you implement the skills that everybody needs to survive in the future world where everything is stored digitally anyway. So personal attacks is something that, there's best practices that can be implemented. And what we'll actually be doing is those that are on the live, if you stay around till the live segment, the bonus just for the live segment, we're going to be doing a sneak peek session where we take some of the mentors from the Retirement Plan B online wealth management program and the experts, and we'll give you a little sneak peek at some of the training there. And so on the subject of security, on the Retirement Plan B online wealth management program, we bring in my go-to expert, and the person that I would go to for all these types of things, which is Andreas Antonopoulos. So if you hang around till the end, we'll play you a little sneak peek so that you can understand a bit more about your personal security. And if you're watching this on the recording, unfortunately, will be edited out because this is only for those that join live. And each of the live sessions, we create a little carrot and stick, as we've said, for those that attend the live sessions, because I draw my energy from the audience and we'd love you to be in live rather than actually doing that. So now I'm going to head over back to the big screen so that we can go to reason 5, supply shocks.
Okay, so coming back over to the big screen, and there you can understand a bit more, and we'll go through the other 2 reasons why people have decided that they don't want to participate in this market and the retirement plan B approach. Right, next one. The next one is supply and demand shock. So many people don't get on board this because they're concerned about a couple of supply and demand shocks. I put this mainly into 2 of the main objections that people cite again and again and again as a justification for why they are not putting some of their wealth or retirement plan in the Bitcoin markets once we've gone through this. And that is the 2 really supply and demand shocks. So Economics 101 states that supply and demand dictates price. And when you have, more demand, or you have too much money chasing too few goods, for example, you get inflation. And the price is determined by the supply of goods. When you have a shortage, for example, there's a global shortage of developers at the moment, and their salaries are being pushed and pushed up because there is a global demand to take all of their businesses online. And eventually more and more people recognize that and they adjust to becoming developers, and then you end up with the demand saturation and prices going down as well. So supply and demand does that. So in Bitcoin, you have these supply and demand shocks that people are concerned about. The first main one is being discussed at the moment, which is the Satoshi coins. And the Satoshi coins have been involved in allegedly a gentleman called Craig Wright claiming that he can control those private keys, and there is a court case with Wright versus Friedman. Kleinman, Friedman, talking about economics there, Martin Friedman, losing my mind at the end of the day. So Kleinman allegedly had a mining business, and he has died. and passed away. And the estate of David Clayman is claiming and trying to claim that these early coins are that. And so that is being resolved in a court right now. Interestingly, Craig Wright, the person that claims to be Satoshi Nakamoto, who claims to have control of these, also said that the wallet addresses that he owns and he controls were the same as the Mt. Gox wallets that hold many of the Bitcoins that were fraudulently involved in a settlement during that. So, we're going to, really find out. And so, if the Kleiman case goes in his favor, we're on day 7 today at the moment. Then this claim would be that those coins have to be transferred. Some of those have to be transferred to the estate. And then we find out whether Craig Wright does, in fact, have access to those private keys in one of the most strangest and interesting cases in law at the moment. So people are concerned about whether that's, but we're going to find out very soon whether those coins can actually be moved, because there'll be demand by court. And my guess is that it will expose that those coins cannot be moved, and the private key is most likely owned by somebody that is no longer with us right now. And so that involves $1 million Bitcoins, currently worth over $68 billion, as a potential supply shock that people are concerned about. However, if you are a fiat thinker, then you would certainly be concerned about those Bitcoins hitting the market. But if you are a Bitcoin thinker, then you would see that as a great opportunity for the supply shock to suppress the price of Bitcoin, so that you can then use it as an opportunity to accumulate more Bitcoin, because the fundamentals of money you can own, money you can spend, and money that cannot be changed by the whims of anybody, and the world's best shot at ever achieving digital hard sound money still exists, is fundamental use case, whether those Bitcoins hit the market or not. My guess is that they won't hit the market, but it is still some reason that people say of why they are missing out on this ginormous wealth transfer that's happening as the industry has grown over the last 12 years in that bull market. The second thing that people talk about, and full disclosure, I am a shareholder in a company called Bitfinex, and Bitfinex is an exchange that also the management team run a stable coin called Tether, and it has been involved in a sea of controversy time and time again, and people have often put out news and headlines there that the whole Bitcoin market is some kind of Ponzi scheme whereby tethers have been printed into existence and they are being used to buy Bitcoin, and therefore the market is completely fake and one day tethers are going to blow up and destroy the entire market, and we're all going to find out that we were all idiots involved in one of the, trying to play the greater fool philosophy. The challenge with that is that if Tether does blow up, and again, I'm not putting speculation on that. I've covered this topic a lot on my YouTube channel. And again, full disclosure, I am a shareholder in Bitfinex through BnkToTheFuture. And I always try and disclose my shareholdings wherever I can. One I forgot to do is people were talking about Coinbase. I was a shareholder in the private company and now still the public company as well. But the saying goes that Tether's going to blow up and it's going to destroy the crypto Bitcoin market and all of this fake demand's going to disappear. But if you had Tether and you were finding out and you were fearful that your Tethers were about to blow up, what do you think most people would do with them? They'd take them to an exchange and they'd buy money you can own, money you can spend, and money that has a fixed supply called Bitcoin. So to me, the Tether fear and implosion is one of the China bans, where it initially has a shock on the price, but then everyone, if they get access to those tethers would be used in order to purchase Bitcoin as they trade out, especially as the whole insiders or whatever might be being involved in that. So again, these are the headlines that drive people into missing the being involved in what this redefinition of financial services that is coming as a result of the world having the first shot at ever having digital hard sound money. Okay, we've got two more. Reason 6, I'm going to pass through this one because tax and inheritance complexity. This is why you should definitely come to Masterclass 2 and Masterclass 3, where we'll be going through some of those structuring conversations. And as I said, I can't give tax advice, I can't give legal advice, but I can share with you, because I have paid millions of dollars to tax advisors and legal advisors in structuring my retirement plan B. And I can certainly pass on some of the things, but remember, you still need to bespoke it to you. And I don't know you, I don't know your situation, I don't know your assets, I don't know your liabilities, but those that are joining them going to be one of those 500 spots on the online wealth management program. Will be giving everyone the tools to put together their plans and give them the plans that they can take to their tax advisors and legal advisors and see how it sits in with their personal situation. Okay, so we'll pass through that one, but it's very real, and this is something that does need to be figured out. Making sure that you've structured the right thing to have the right asset protection structures and structures that can be inherited by your loved ones, because Bitcoin is brutal. The supply often shrinks because people don't think about their asset protection structures and inheritable structures. And when people pass away, just like maybe the Satoshi coins, you end up with those private keys disappearing and never to be accessed again, which is also a supply shock as more and more people lose those private coins because they don't focus on the security. And as said, we'll give you a sneak peek of the security bonus module with the guest experts that joined the Retirement Plan B Wealth Management Program, Andreas, for those that hang around for the live. If you're watching the recording of this later, then unfortunately it will be edited out at that stage. And every time we do go live, there'll be a bonus at the end for those as well. And finally, reason number 7. So let's recap what we've done here. We've given 5,000 years of monetary history. I've shared the approaches that we use and the economic trends and how to analyze and be protected from inflation, deflation, economic growth, economic decline. I've shared in future masterclasses when we go through the exact strategies and how to build the retirement plan B. And then we've got the reasons why people use in order to listen to others, see the headlines, and that drives them into trading where they end up selling their Bitcoins to the accumulators. The final one that we have covered, and it brings us full circle right at the beginning, is playing the trading trends. It is tragic that I know people that were at the very first Bitcoin conference and been around for years, and they have tried to trade their way to returns and ended up with no Bitcoin in the end, and ended up being involved in the highest performing asset class in history and still not benefiting from the growth of that because they're over trading, they're trying to call the tops, they're trying to call the bottoms, and they're trying to look at when Bitcoins seem expensive, like when they're at all-time highs, they're not willing to buy, and they say to themselves, oh, I'll wait for it to be cheaper. And when it goes into a crash, they get driven into a fear mode and never end up buying as well. And I've seen countless people, countless friends outside of our crazy Bitcoin community that have completely, not been involved in this industry because they think that it's too expensive when the price is high, and they think it's dead when the price is low. And the famous Bitcoin Habituaries website lists every single time over the last decade that somebody, well-prominent figures, have claimed that Bitcoin's died, and one by one, they all come over until the last man standing, Peter Schiff, will take it to his grave, and all of the wealth that he's generated as a result of preserving his wealth through gold will be passed on to his son, unfortunately. I love Peter Schiff. But we're all going to pass away one day, so we need to plan our inheritance, and then the young generation get on board into the asset class that is more aligned with their belief about the future as we move into metaverses and all sorts of things as the industry grows. So the expensive dead cycle, and now I think this is a great time to pull in Azad, and we're going to now head over to the Slido board. Now, there are tons of questions, so thank you to everybody that headed over to retirementplanb.com. And Azad, I think we're going to now do a screen share, and we're going to take as many questions as we can. Always, and remember, we are going to be doing a short segment where I give people a sneak peek from Andreas Antonopoulos, and we'll do this in every single live masterclass. So if you've enjoyed this, I hope you've immersed yourself. I hope this has given you plenty of food for thought. And remember, we're still going to be covering, this is just the first masterclass. And by the time we get to video 4, we're going to be working with those next 500 people that want to do the wealth management program as well. But between then, we're going to be answering as many questions. I covered a lot of content. In the future ones, we'll try and cover more content. And we'll also save some of those case studies where you can see people over the last year that used the retirement plan B and some of the results that they've achieved. So Azad, hopefully we can, you're coming through now. So should we pick up some of those questions?
Yep. I guess we've got quite a few questions related to the Retirement Plan B online wealth management program. So how do we get invested in this Retirement Plan B? Is this investment plan open to retail investors?
So the Retirement Plan B, so we have a couple of products. The first is the Retirement Plan B Wealth Management Program. That's open to 500 people. We took on 500 people last year. And we will be taking on another 500 people. You do not need to be high net worth. It's open to retail. You can take that and you can implement all of the tools and go out and build your own retirement plan B, and we self-empower you. We also have a product that at the moment is only open to high net worth investors, and that's our portfolio builder product. You'd have to have a high net worth investor account on BnkToTheFuture.com, and that's where we automate the whole process. So what I did over the last year is I took all of the structures and everything that I've used for my retirement plan B and made it available. Now, next year, we are also applying for an additional license that would open that up to non-high net worth investors, but I can't promise that because it depends upon a regulator saying that this is a product that is appropriate for non-high net worth investors too. So just to recap that, the program, the 500 people, that is open to both retail and high net worth. But the portfolio builder product, where you can automate the whole process and use our structures, that's only available to people that have certified high net worth investor accounts on BnkToTheFuture.com. But we'll be applying for a license in order to scale that and open it up to as many people that want to build long-term retirement plan Bs in the future through our automated portfolio builder product. Next question.
Okay, we got quite a few thumbs up for this next question, which is, I see a lot of people buying and holding ETH as opposed to Bitcoin. What is your view on this?
So ETH is part of my retirement plan B, and ETH did outperform the Bitcoin part of the portfolio. And the way I think about ETH is, firstly, it's not digital hard sound money. They have just rejigged the economics in order to make it more like Bitcoin type properties in terms of its supply. And so that has factored into the price recently, but it's a completely different risk profile in terms of it has a different goal. It's become the base layer for decentralized finance, something I think is very important. If you watch my video in the mornings, if you follow me on Twitter at Simon Dixon Twit, before my workouts, I try and give a quick, I'm trying to get myself in shape. So I gave a whole update on DeFi. And really the simple place is Ethereum is the base layer for that. It's got incredible adoption at the moment. It's got incredible community. But don't mistake it as a competitor for Bitcoin. It's a different use case. It's got a place in my retirement plan B. And when we go through the Masterclass 3, where we go through the strategies, you can see how Ethereum is part of that, but still Bitcoin is, Ethereum is a way of accumulating more Bitcoin through the wider crypto markets by going further down the risk curve and following a proper asset allocation approach. So yeah. Full disclosure, I did invest in the original token sale for Ethereum, which was sold to the Bitcoin community. And I do hold, as well as Bitcoin, I do hold some Ethereum for full disclosure.
Okay, why could there not be another decentralized Bitcoin copy and paste protocol? Only 21 million coins, not another centralized shitcoin.
Because Bitcoin was created at a time when nobody cared, in a freak set of circumstances that no one has been able to replicate ever since. And so because when Satoshi Nakamoto created Bitcoin and released the white paper, and it was released at a time when there was no exchanges, no trading, it was a cypherpunk movement from the ground up with, I was the very first finance person to really publicly speak about Bitcoin when I spoke at that first Bitcoin conference. And it was really a us versus the banks, because I came from a monetary reform. I was trying to share my experiences of finance to the tech geeks, and it's a cypherpunk movement. Everyone that has tried to create anything since has been affiliated with a character, and then it becomes security-like, and then it has regulatory challenges, and then it can't achieve the same level of decentralization because things feel scammy when they're launched by anonymous people at the moment. And so you can we've never been able to replicate it. And Bitcoin, for all the reasons that we covered here, has proven itself as completely anti-fragile and something that just has never been replicated as well, that was created at a time when no one cared, no one was speculating. If you try and create something today, every VCs are in, everyone's looking to the leader, and you end up creating something that looks more like a company or a security, as we have seen time and time and time and time again. Decentralization is incredibly hard to achieve. To create a network effect of the largest supercomputer in the world has been impossible to achieve, and every time someone has taken the code, tried to do the same thing, they end up creating something that does not have the same properties of Bitcoin.
Okay. Here in South Africa, we are being stopped by the banking cartels from buying any crypto via their systems and currency control regulations. What can we do?
So you need to find services that are regulated that allow you to offboard onto fiat. Firstly, you need to work with a crypto-friendly bank. And part of what we cover is analyzing how to find those crypto-friendly banks. At BnkToTheFuture, full disclosure, I've been investing in crypto-friendly banks. So FV Bank is one of those banks that recently is funding through BnkToTheFuture.com that's looking to serve the market, and there are other ones as well that are coming through. Banks are getting involved in the industry right now. More and more regulations are being put into place. So offboarding, unfortunately, onto fiat, you can use, if you have an account on BnkToTheFuture.com, you can offboard from fiat into virtual assets using many of the different mechanisms like stablecoins. So you need a crypto-friendly bank. You need a platform that has the regulations not to be in a regulatory gray zone so that it gets banned by banks. And then once you're offboarded, you can start playing around with the crypto sector and the crypto industry. It used to be infinitely harder to do it. And so it's really about playing where you are welcomed rather than playing with those banks that you're not welcomed. And that normally involves changing banks and rethinking and working with some of the companies that are innovating the financial technology industry.
What do you think of MicroStrategy for ISAs as a Bitcoin proxy?
So you could use MicroStrategy in your ISA, but you've now got exchange traded funds. So MicroStrategy is a public company that accumulates Bitcoin and has an incredible amount of Bitcoin. I think last time I looked, over 100,000 Bitcoin. And so people are using it as a proxy for Bitcoin. I've had to do all sorts of things. So when I worked in investment banking, I had this worthless thing called a pension. I was trying to figure out what I could do with that pension, and it was stuck in, and I managed to transfer it out to a self-invested personal pension. And then I had to find all these weird, strange products that I could put it in, and I just found this Swiss krona denominated Bitcoin product. And I was using Hargreaves Lansdown, which is a public company in the UK, managed to get the money into the pension, managed to get into this weird company. And sometimes you have to do that. But now the products are coming out. I'd expect by next year to have, well, we've already got Bitcoin exchange traded funds, and you can see more and more things as well. But also when we go through the structuring side, retirement products are great for their tax deferral benefits. But also on the structuring side, so you can do legal tax deferral. That's a very crucial part of that, is doing it in the legal way, so that you can rest at night knowing that you're doing things the correct way. But MicroStrategy is one way of doing it. I think there'll be better products over time, and we're almost there. Next question is us.
Yep. What's the best crypto-friendly banks?
So there's a wave of challenger banks that are coming through. The challenge with crypto-friendly banks is they don't like to publicize that they are crypto-friendly banks. So full disclosure, I'm shareholders in companies that are becoming banks. Coinbase is becoming a bank. Kraken is becoming a bank. FV Bank was one of the companies that we invested in. And so sometimes you have to plug together different types of financial services to get there. There's a list of them that don't like to publicize that they are crypto-friendly banks, because once they do that, they then get attacked by their bank that they sit on top. So it's something we do. We have made introductions for our online wealth management program things, and there is a wave of different crypto banks out there. I think I've covered stuff on my YouTube channel as well. But that's one of the protections that we make sure that people are set up. And it really depends on your net worth, where you're participating, which country you're from. But that industry is growing and growing and growing.
Okay, great content, Simon. Curious to know if you have an exit strategy for Bitcoin when we get towards the end of this bull run. And if so, what is it?
So an exit strategy for Bitcoin in Bitcoin thinking world is asking the question, what do I buy with my Bitcoin? I don't sell my Bitcoin. If something is going to be bought with my Bitcoin, then it has to be a damn good reason why I'm doing it. And so one of the things that I've done is I put together my balance sheet, my personal cash flow. I understand my net worth, my assets, liabilities. I put together a financial plan to determine how much I need for security. So one of the things I wanted to do was not be dependent upon anybody. So part of my security was owning my house outright with no bank that could take it away through a mortgage. And so that was part of my goals a long time ago. As you know, if any of you know my story, I was deep in debt, had to put together a balance sheet, had to put together a cash flow statement, chip away at my debt, and then put together different bucket allocations. So one of the things we do is separate out money that you're spending, money that you're investing, and then separate out further between money that you're going to never take out in a compound effect and money that you're going to be using to achieve your dreams and financial goals. And we give you people all the spreadsheets and tools on the wealth management program to go through that. So I just follow the book. I don't make subjective decision making. And so when I'm going to be taking my Bitcoin, there needs to be a reason of why I'm going to buy something else. I don't understand the concept of selling Bitcoin. I don't want to create taxable events. I don't want to end up a trader. I don't want to try and call the tops, call the bottoms. I want to be allocating dollar cost averaging in and having a strategy of, if I am going to buy something with my Bitcoin, then it's part of a planned out, achieving certain goals and setting those. And that really depends upon you taking the time to understand your personal debt situation, your assets that you have, your liabilities, and taking that time. And so there's most people don't do that. And so what we do is we force everybody to sit down, use the spreadsheets in a supportive environment with the community where everyone's helping each other, and take that time out to do the things that they never took the time out to do, that avoids you making all these subjective decision making on when to buy, when to sell, what to buy, what to sell. We want to take all of that out of it. And that is the goal behind the retirement plan B, so that you can just sit back, relax, and have a plan, know what the strategy is, know when to follow that, and that's really the goal. So Azad, I think we're going to be able to do, let's see, so I think we want to wrap up. We took a bit of time, so we were going to be ending at 8:30. Here in my time zone, it's about 20 minutes past 8. So let's try and make up for some of the time we lost due to the technical issues. And then we're going to move over to the secret segment. And the secret segment is where Andreas Antonopoulos will be sharing and giving you a sneak peek in the online wealth management program into some of the security considerations and answering some of those questions that came up around custody and self-custody. So maybe I'll try and give some shorter answers. I've been told that I waffle. Very hard for me to give short answers because I'm just so passionate about delivering as much information to give you what you need to try and put this into action and do what's right for you. So let's take a few more questions.
Okay, we've got a question from Tracy. I have 11 Bitcoins. Cost basis is 6,000 per Bitcoin. I don't want to hold into a big correction. If I sell, I will incur UK capital gains tax. How can I protect myself from these capital gains tax?
So this is very much getting into individual financial planning. So in terms of understanding cryptocurrency tax treatment, that's one of the topics as a non-tax advisor that we'll be covering in Masterclass 2. In terms of asset protection structures, that's what we'll be covering more in Masterclass 3. And then in terms of determining when to buy, when to sell, hopefully you appreciate that it's about putting together an individual financial plan, creating these different allocations and doing what the professional money managers that earn billions around for managing the vast amount of wealth. What we try and do is we try and take the strategies used by the wealthiest 1%, and put them into asset allocation and spreadsheets so that you don't need to make these decisions, and you can just simply follow the strategy, follow the plan, and automate much of this decision making. So I'm going to deviate that for going deeper in the complete 4 masterclasses. And this is the individual type of financial planning that we will be doing with the 500 people, giving them the tools so that they can make their own decisions and know how to plan out these things.
How do I pass my Bitcoin and other digital assets onto my kids, especially on my ledger and on the exchanges?
So what we'll try and do is one of the bonus segments on the third part where we talk about structuring is bringing in the experts. We have Pamela Morgan that put together a digital asset inheritance plan and all of the things you need to consider by tying it into the security and putting different structures together. And so really that comes into a structuring conversation. So we want to give you some of the information that you can then take to your estate planning and legal advisors to pass that on. But inheritance is one of the big challenges, and that's really the topic of Masterclass 3.
I'm 99% in Bitcoin. Do you sell and take some risk off into gold in this cycle?
So no, I don't sell into cycles. I define my retirement plan B strategy and I increase. My goal is to always, every single month, own more Bitcoin than I owned last month. And so that's always been my goal. So that means that I dollar cost average in. I don't sell into cycles. I define my complete asset allocation. And when we go through strategies in Masterclass 3, you'll see my complete strategy mix. And then I accumulate and add to it based upon whatever is left over that month, based upon my defined financial plan, as opposed to trying to make decisions, emotional decisions, trading in and out, trying to decide when to hedge into gold and all that stuff. I'm automating the whole process, and that is the retirement plan B approach. So no, you won't find me selling into gold. Gold is a part of what my different allocations that fulfill certain goals, but I'm not going to be selling Bitcoin in order to buy gold. That doesn't happen as part of the retirement plan B asset allocation and approach.
Okay, can crypto investment be put into SIP and SAS retirement plans in the UK?
So there's more and more financial products that allow for that, and really going through structuring is one of the topics of the Masterclass 3. So these questions are fantastic. It really helps me know what to cover in future masterclasses, because as you can see, we're covering this live. And so, yes, there are ways of holding those assets within self-invested personal pensions and various other retirement structures as well. Okay, so I reckon we're going to do two more questions, I think. And then I think we're going to use this board, move it over to Masterclass 2, which is going to be happening the same time, 5 p.m. on Friday. Hopefully we've learned so much here between our small team of 3. Azad, Dave, and myself got through all the technical issues. So thank you for everybody that got the patience there. And also, please remember, we're going to do 2 more questions, and then we're going to move over to only those that are left over in the sneak peek live segment. This will be edited out afterwards from the live broadcast. And we'll be doing one of those in each and every broadcast where we bring in the experts, and we'll be playing some of the content from Andreas. But if you've enjoyed this, I request one thing from you. Please do share this retirementplanb.com with as many people as possible. If you think they would benefit from this, we will have the recording available for those that want to catch up on this. And so please do, if you've enjoyed this, please hit that like button. If you're watching this from YouTube, make sure you subscribe so that you get notifications. And the algorithms will really appreciate any likes that you give, any comments, any chat. It's been an epic event. We've really enjoyed delivering this content for you, and we've got so much more to go in this live masterclass. So if you've enjoyed it, then that would be my favor that I'd ask for you. We're going to teach like crazy. I'm going to give as much content as I can. I'm going to answer more questions in the upcoming lives. I was a bit content heavy today. I'll try and cut it down so that we can get through more questions. Yeah, so I'd really appreciate any likes and shares you can do, and share this with anyone that you think could benefit from it. Okay, Azad, let's do the final 2 questions, then we'll go to the live bonus segment.
Do you see central banks not increasing interest rates over 2022?
So I do not think that central banks can increase interest rates, because central banks have already shown a desire to remove the free markets, transition from free markets over to a more socialist way of organizing money, move over to modern monetary theory, where you combine, fiscal government goals and objectives with monetary policy, and release the central bank digital currency is what I'm forecasting when you have systemic risks in the banking system. Now, if interest rates go up, that could be a trigger for a deflationary spiral, an economic downturn, and we are in the only time in history that we have ever organized our economy in this way, where we have thrown the entire monetary system under a bus in order to make sure that markets do not correct themselves during this pandemic. This is uncharted territory. And quite frankly, putting up interest rates is just something that is not really an option. And so I think that they would choose the removal of bank-created money as a deflationary spiral to try and combat some of that inflation, technology combating the inflation, and then unleveraging the debt. And so remember, inflation to me is 2 phenomenons. It's the leveraging of, it's the interest being for prices because all money is created as debt through the private banking system, and is also too much money tasting too few goods, traditional economics 101. Combine those, and so the way that you combat inflation, traditionally you would have used interest rates by sending all the people that took on the debt bankrupt so that they can no longer pay, and you have a correction in prices. But central banks have decided and governments have decided that markets are no longer something that can be done. So I don't see interest rates going up. And if they do, they're doing what they need to do to deleverage and unwind and reverse some of the damage that they've done. But I really don't think we're going to see that.
Are you afraid that the powers at play could take your amazing knowledge and disappear? They don't want us having our own rules like blockchain and Bitcoin.
Well, if they had a choice in the matter, as I covered in the 7 reasons, that if they could have banned it, they would have. But what we have seen is that every country that has banned it ends up giving waves of innovation. So fortunately, we have competing countries that are all engaged in currency wars and competing agendas. And so when one country says, let's take this away, then it moves over to another country that sees that as an opportunity to take all the jobs, all the growth, all the environment, make it legal tender. And then as we saw with countries like Bulgaria, where Bulgaria many years back confiscated a big chunk of Bitcoins and ended up holding Bitcoins that were worth more than their national debt, but the crony politicians ended up ciphering those out, and they just disappeared into the pockets of politicians rather than getting the country out of debt. So fortunately, we have an environment where those that adopt this early can end up in a David beats Goliath situation, as I've constantly talked about in different scenarios I've played out on my YouTube channel. And so therefore, do I fear these things? I'm just seeing the exact opposite. And what's the other reason? Tax, baby. $2-3 trillion market. The governments want their cut. Banning it means that they don't get their cut. They would much rather tax it so that they can get their cut. And so it's already being embraced. These products are being created. It's being put in pensions. It's being put in retirement plans. And so, as I said, we've got these trends that I talked about that means those things were genuine fears at one stage. And every single year, it's been less and less of a fear due to that. So thank you very much for those questions. I am really, really energized by the fact that there were so many questions and so many people engaging on the Retirement Plan B website. And we are going to be back on Friday at the same time as 5 o'clock. We're going to dig a bit deeper onto many more of your questions on the tax side, but please remember, I'm not a tax advisor. I'm not your tax advisor. All I can do is share some of the things that I've done and how I think about these things. And number 3 would be going more on the structuring. And then number 4 will be answering more and more questions, trying to get much of the information. For those that can't make the 500 slots, we'll be giving as much information on that as well. And then the people that will be joining for the 500 will get to work with them on the Retirement Plan B online wealth management program. So as a thank you for putting up with technical issues, I hope you enjoyed it. We really enjoyed doing these different formats and having the big screen and messing around. I have never seen so much technology plugged together. It was inevitable something would go wrong, but I reckon on Friday, I don't want to jinx it, we can learn from some of the things that went wrong tonight, and hopefully Zoom and the internet and the satellite that we put on the side of the building to let the stars and the moons all shine and let this happen will allow this to work. So thank you to everybody. We're now going to move over to the secret, the bonus for the live viewers. And this is a sneak peek inside the Retirement Plan B online wealth management program. We even forgot to cover some of the case studies, unfortunately, but those case studies are awesome to see how everyday people have been using the Retirement Plan B over the last year to achieve incredible results. And so we're going to move over. I'm going to head over to the screen again, and we're doing the live viewer bonus, which is where my good friend and Andreas Antonopoulos who has been just a beacon of light to the crypto community. Educated so many people in the early days and still today, was author of Mastering Bitcoin and Mastering Ethereum, and was even at the Craig Wright trial testifying and educating the jury on Bitcoin. And so we were delighted that he decided to be a part of the Wealth Management Program, and very rare for somebody that protects his reputation so high to be willing to actually produce content for that as well. So we're going to move over to that sneak peek. If you're watching the live, you'll be able to watch that. And if you're watching the recording, that will be edited out. And so join us on Friday at 5 p.m. GMT, whatever that is in your time zone. And we'll be emailing out tomorrow. Make sure you're on the list so that we can notify you on retirementplanb.com. Thanks, everybody. And we're moving over to Andreas. We'll see you on Friday.
Hi, I'm Andreas Montanopoulos. I'm going to teach you about security of crypto assets, custody, and risk management. First, I'll introduce some concepts. Custodial services, on the other end, self-custody, and right in between, hybrid solutions. I'm also going to talk about understanding what threats you face, how to build a risk model to mitigate those threats. Then, we'll talk about the basics of keys, mnemonic phrases, multisig, and hardware wallets. Finally, we'll get to backing up, storing, and restoring your mnemonic phrases. With all of this information, at the end of this workshop, you'll be ready to decide whether you can self-custody your crypto assets or whether you need a custodial or hybrid solution. And you'll be ready to take the next steps to put this plan into action. The first and most important topic we'll cover is custody. Unlike traditional financial services, whoever controls the cryptographic keys controls the funds. That's a fundamental difference, and it's the basis and one of the major benefits of cryptocurrencies and other crypto assets. If you have control over your keys, you have control. So understanding custody is critically important. So important, in fact, that I created a little slogan to remember this concept, and that slogan has become so popular, it's now on t-shirts. Not your keys, not your coins. If they're your keys, they're your coins. If you don't control the keys, not your keys, they're not your coins. In fact, they effectively are under the control of someone else. If someone else has control, we call that a custodian, and the service that offers that is a custodial service. If you have control, then effectively you're the custodian, but we call that self-custody. Not all systems have to be on these two extremes, however. Due to a particular feature in cryptocurrencies called multi-signature solutions, you can have control delegated to multiple parties. You can have some degree of control through your keys, and you can also delegate some degree of control to a third-party custodian, creating a hybrid solution that isn't custodial or self-custody, but somewhere in between. So on this journey, you have to decide if you're ready to take full self-custody and control, with all of the responsibilities and risks that come with that. Whether you're not ready and you would rather have a third-party custodian who has fiduciary responsibility with the additional risks that come with that, or whether you're willing to advance your technical skills a bit in order to build a hybrid solution using multi-signature technology. And we'll understand all of these balances, trade-offs, and risks in the rest of this workshop.